Hello, everybody. It's time, so we'd like to start the meeting today. Good morning, good afternoon, and good evening to everybody. Welcome back to the second day of the public consultation meeting on the review 2020 of CBC reporting. Before start the meeting, I would like to give the floor to the Secretariat for the housekeeping announcement. Wanda?
Yes. Thank you, Mr. Chair. Good morning, everyone. Good afternoon here in Paris. Good morning, good evening in the different time zone. Thank you very much for joining the second day of this public consultation meeting on the country-by-country reporting. We are really glad to have you virtually present. We had yesterday a very good discussion. I think it was a very good meeting. We had a very fruitful discussion from the panelists and from participants. We get a lot of comment orally and also in the chat. However, we encourage you to raise your hand and give us your oral comment, because that will help us that will invite more discussion in the room. But we appreciate any of your comment, and we are taking note of all the comment that has been raised during this discussion yesterday, and we aim at doing that as well today. Today's agenda will cover various issues that has been put forward in the public consultation document. We have some options that has been raised in the document, and some different alternatives for each one of these issues. I will just want to say that many of those issues, there is no discussion, an agreement from the delegates. So we really welcome your views. We really welcome your comment on all the position that has been put forward. What are the challenges that you think those options or those approaches may represent for MNEs? So we really appreciate your view, because that will help us, will help the Working Party 6 and the Working Party 10 to finalize this project and to make the technical work, and for the inclusive framework to make the decision, or to take a more informed decision. So in terms of today, I think on the logistic, I won't go into much detail, because I think many of the participants that are joining today were here yesterday as well, and I think you are quite familiar already. Just a quick reminder that I want to give to you is just everyone mute your microphone. That will help us to listen better to our speaker. It's very easy to do. You just have to press in the mute button, or the mute icon that you have in your screen in the bottom menu. If you have any question, once the chair has opened the floor to the panelists, just raise your hand. If you want to raise your hand, you just have to go to the participant bars, and you're going to have the option to raise your hand as well. And of course, once the chair has given you the word, just please unmute your phone or your microphone. In terms of, if you have any issue regarding the technical thing with the Zoom, we have Sonia that is helping us, and it shows in your bar as OECD support, Sonia. So you just can send us or send her a message. You have also two other person, Katja, that is also supporting us. So you can just, if you have any technical issues, just write in the chat privately to one of our support team. And then just to remind you as well, or to tell you that this meeting has been recorded and will be made public. And the session from yesterday is already available in our public consultation page. So I think that's the only announcement I will want to do. Again, thank you very much to all of you, and thank you all to all the speakers and delegates and participants. And I just wish you a very interesting date and with a lot of interesting discussion. Thank you, Mr. Chair.
Thank you, Wanda. Okay, let's start today's agenda. As you remember, yesterday we talked about the general issues related to BEPS Action 13, and also some issues related to the content and also scope for the CBC reporting. Today, we are going to discuss remaining topics. Today's topics may be a little bit more technical than yesterday, but still they are very important for us in the 2020 review. Your contribution would be highly appreciated. So I would again encourage all the participants to express their view actively. Okay, let's start item 5, which comprise of 2 topics relating to the scope of CBC reporting. The topics to be addressed in these items are 5A is should a single enterprise with one or more foreign permanent establishment be a group for a purpose of CBC reporting? And 5B, should separate CBC reports be prepared by groups that are under common control and which in aggregate have consolidated group revenue above the CBC reporting threshold? These topics correspond to the question number 4 to 9 in the consultation document. Like yesterday, I would first like to invite the lead speakers to share their views on these issues. First speaker is Ms. Maria Abuimporto, International Tax and Transfer Pricing Manager at Ferrovial. Ms. Abuimporto, floor is yours.
Hello, everybody. First of all, thank you to the OECD. We are grateful to
Could you speak a little bit louder?
Yes, can you hear me?
Yes.
Yes, perfect.
Much better.
Yes, yes. We are grateful to take part in this interesting forum, so thank you very much for the invitation. I represent one of the multinationals that are suffering the burden of CBC reporting every year. So Ferrovial is a Spanish multinational which manages big transport infrastructures around the world. We are present in 36 countries, and last year we reported 521 entities in our CBC, which is a quite big amount of information and is not always easy to gather. Obviously, we are in the era of data analytics and artificial intelligence, so everything can be done. But when you are acquiring a group, their accountancy systems is different to yours. Migrating all this data to your systems means time to do it and investments. Yesterday, hello? Hello?
Yes, we can listen to you. There is hello.
Okay. Now, can you hear me?
Oh,
Yes.
it's better. Yes, we can hear you. Hello, we can hear you. Can you hear us?
Hello?
Can you hear us?
Yes. Now I can hear you. Can you hear me?
Yes, yes,
Okay.
I can hear you as well.
Okay.
Go ahead.
Sorry. Yes,
no problem.
Yeah, I was talking about that. Yes, you have to do a lot of investments and time when you have to migrate all the information and data when you are acquiring a company to your systems. So yesterday we were talking about that multinationals are great making procedures, but any change in the information to be reported, multinationals are facing costs to adapt their processes to the new requirements. So we should be very careful with it. We should promote transparency, as yesterday we said, and trust of our communities and societies in multinationals. making that the multinationals pay the fair amount taxes in each jurisdiction. But to do that, we have to design the perfect system and avoid duplicative information. Because, for example, if we are including CBC data in the non-financial reporting directive of the European Union, we might not be obliged similar data, but maybe changing the perimeter of entities or other small changes in a different tax form. Coming back to the topics that we are discussing in our panel, and regarding the first of them, we understand that a single enterprise that is established around the world throughout permanent establishments should be included in the CBC, because the permanent establishments are constituent entities. And we cannot forget that the CBC report has been designed to be a high-level risk assessment for the tax authorities. And for reach this goal, the permanent establishment data should be included. We also consider that not including permanent establishment should be discriminatory, because some group of companies have to invest through subsidiaries because business or regulatory reasons. We would like to highlight that under the unified approach of Pillar 1, we are seeing a change from tax allocations from a territoriality principle linked with the permanent establishment to a sales principle. So probably after this change, the information in the CBC should be reviewed. Regarding the second question that is in the next slide, so yes, thank you. We are talking about of a changing in the obligations of reporting CBC, and we are changing from a consolidated financial accounts requirement to a common control, understood as participation over a 50%. We consider that this new approach would avoid discrimination of investment groups that are industrial groups against investment entities, which are exempt from consolidation of financial statements, but are competing in the same industries. For example, a clear example are the public-private partnerships. And related to this, we think that a mention that is made in the public consultation document to exclude the collective investment vehicles of this obligation of the CBC should be removed, because in this way, all the business players would support the same compliance costs. In this way, tax administrations would gather not only information of common controlled groups by industrials, but also by financial players. Obviously, the new entities affected for the CBC report will support higher compliance costs, but obviously, as far as the financial capacity of the multi being taken into account to impose the CBC report, we consider that the financial capacity of these ultimate parent entities would be similar to the multinational. So we could face these costs. Cons, obviously, is the inclusion of small and medium-sized groups within the reporting entities or the reporting groups, because are controlled by a common ultimate parent entity. But we can avoid this problem introducing a minimal individual threshold for the controlled groups. We think that is a key point, that the reporting under this approach will be made at the controlling group entities in the CBC, identifying the common ultimate parent entity. Because if not, probably we will face a problem of lack of information at the ultimate parent entity level. Okay, thank you for your attention.
Thank you, Ms. Avoimporto. Now we have almost 200 participants, and I'd like to ask all the participants to mute your microphone. I see some of them are still unmuted, but if you are not speaker, please mute your microphone. Thank you. Now I would like to move on to the next speaker, who is Ms. Olivia Lally, Senior Policy and Advocacy Officer, Tax Justice at Eurodat. Ms. Lally, floor is yours.
Thank you, Chair. And good morning, afternoon, and evening to you all, depending on where you are. It would be great if you can go directly to the second slide. I'm pleased to share a brief overview of the Joint Civil Society Coalition, supported by the 15 coalitions and organisations on screen. I'll briefly discuss our concerns with the BEPS Section 13 and system of automatic information exchange as it exists, and the parallel developments in country-by-country reporting alongside BEPS Section 13, because we believe this is fundamental to understanding why there should be changes to the template and the approach taken, in addition to specifically addressing the question of scope. You can go to the next slide, thank you. I think it's important to start by saying that we're having this conversation in an entirely different context. The unprecedented crisis, offset by COVID-19, is global in nature and it will require global solutions. It has exposed the endemic underfunding of public services, including in the health sector, and the impacts of austerity and the last financial crisis. So it is not surprising that tax avoidance and transparency have already been the subject of significant public debate. From Belgium to Canada, India to Poland, we have seen public officials discussing ways in which to prevent public support from ending up in tax havens or preventing tax avoiding companies from receiving state aid. The struggles that governments are having to ensure state aid does not support tax avoidance evidence an urgent need for transparency, including public country-by-country reporting. Next slide, please. We believe that the existing system should evolve to public country-by-country reporting so that all tax authorities and governments would have access to information, as well as providing citizens, parliamentarians, trade unions, journalists, and civil society organisations with information that is important in assessing the effectiveness and fairness of the corporate tax system. Next slide, please. As such, I'd like to address first some of the limitations of the existing Action 13 and the system of automatic information exchange, especially in the way this affects developing countries. I'll then move on to our recommendations, including on scope. Many countries, and especially developing countries, do not have access to country-by-country reporting data at present. Our analysis suggests that the agreement and effect requirement of the country-by-country reporting multilateral competent authority agreement has resulted in regional imbalances in access to reports. Equally, many of the governments, the parliamentarians, and institutions that are forming policy on tax don't have access to this data. We believe it is critically important that they do in order to have a high-level risk assessment of the existing tax system and have evidence-based policymaking to improve tax laws. We'd like to echo the points made yesterday in relation to the threshold and would agree that the threshold should be reduced to align with the EU definition of a large undertaking. Estimates from the OECD have suggested that 85 to 90% of the world's multinationals do not meet the current threshold of 750 million turnover. And we heard from the presenter from ECRIT that this is of considerable difficulty for developing countries where data may not have the same relevance. I'd also like to address the lack of transparency which is preventing country-by-country reporting data from effectively informing our dialogue on the tax challenges arising from the digitalisation of the economy. We understand that the OECD has used country-by-country reporting data to inform its own impact assessment, and we believe the same information should be available to all stakeholders so that we can have an informed discussion about the proposals and challenges we face. And finally, I'll share some specific recommendations in addressing the limitations to the reporting template, including on scope, that have become evident. Next slide, please. First, it's important to acknowledge thank you, that more than 100 developing countries were not part of negotiating the original BEPS package, including Action 13. And data from the OECD website suggests that of the 119 countries with activated exchange relationships, only 57 have access to reports, and of this number, only 3 African states can currently access reports. We've also found that appropriate use criteria and the restrictions to local filing can make it challenging for developing countries to effectively use the mechanisms and limit the ways in which they can choose to use data. Next slide, please. Thanks, Sonia. You can see on screen the states that are part of the country-by-country reporting exchange system, but are not in a position to receive reports at present. And the next slide. In parallel to BEPS Action 13, we have seen the emergence of significant developments in public country-by-country reporting, both in terms of legislation and also in the voluntary sphere. We've heard about several of these yesterday, but I think it's important that we learn from the experiences and also from the practice and the analysis of the public reporting that we've seen take place over a number of years. The EU introduced public country-by-country reporting for the banking sector in 2013 to wide public support, and reporting organisations have shared positive experiences. The threshold is significantly lower than BEPS Action 13, and it's very interesting to see that researchers have found that reporting provides greater transparency and data that is otherwise unavailable, and that this data can help identify profit shift into tax havens by European banks. Similarly, researchers have found that the measure has disincentivized profit shift into low tax jurisdictions, but has not negatively impacted on the sector's competitiveness. Equally, it has enabled unique analysis of the sector's activity within tax havens. I'm sure you're also aware that the EU has, since 2016, been discussing a legislative proposal for all sector country-by-country reporting. And the next slide, please. The positive experiences from the EU, as well as the emergence of many supportive businesses and investors, have led to the development of guidance on public country-by-country reporting and a number of voluntary initiatives, including the GRI standard that was discussed yesterday. This has given us a great deal of experience and evidence to build on in showing that public country-by-country reporting has made a meaningful and unique contribution to the debate and to our common objective of addressing corporate tax avoidance. Equally, it has gone a huge way to allaying the concerns shared in advance of BEPS Action 13, especially with respect to commercially sensitive information and to competitiveness. And I think this is really helpful for us to reflect on. Next slide, please. Finally, I'd like to share our recommendations. First and foremost, we feel decision-making on international taxation should take place in an intergovernmental tax commission under the auspices of the United Nations, where all countries can participate on equal footing. Country-by-country reporting must be made public to ensure all administrations and governments, as well as other stakeholders, have access to information. This is critical to ensuring equal access for developing countries, as well as enabling evidence-based decision-making. With respect to the specifics of the standard, we would like the standard to align with the Global Reporting Initiative, as discussed in more detail yesterday, and have specific suggestions with respect to Table 1. And we feel that the experience with Action 13 should be used to create greater clarity and ensure that the data provided in the reports can provide an accurate picture for high-level risk assessment. In the interest of time, I won't go into all of this, but you can find some detail on screen and more detail linked in our submission. Next slide, please. We share a common objective of addressing tax avoidance, and equally of ensuring that country-by-country reporting data provides an accurate picture for high-level risk assessment. And deriving from this, we believe the scope must be expanded. Single entities conducting business in more than one jurisdiction that do meet the reporting threshold should be within scope of country-by-country reporting in order to address the equal risk that they can pose. At the same time, the definition of a constituent entity should be updated to ensure that it's not possible to avoid reporting or circumvent the permanent establishment clause, and it should not be necessary for an entity to prepare separate financial statements. Lastly, we believe the threshold for large corporations should be set to match the EU definition of a large undertaking, given the many reasons already shared and the fact that we have positive experience with this as a reporting threshold. Last slide, please. Thank you so much for your attention and really appreciate the engagement. You can find the full civil society submission here, and I'll share a link in the chat box, and I very much look forward to more discussion. Thank you so much.
Thank you, Ms. Nadi. Now, next speaker is Mr. Alison Lobb, International Tax Partner at Deloitte UK. Ms. Lobb, the floor is yours.
Thank you very much. So thank you very much to the co-chairs and also to the OECD Secretariat for allowing us to contribute, and also for successfully moving the public consultation to the virtual format. So if we move on to the next slide. So the questions that we've been asked to talk about today are around, in particular, the question of a single enterprise that has one or more foreign permanent establishments. We think that such an enterprise and including it within the C/C reporting rules would be consistent with the principles and objectives of C/C reporting. If we were to do that, I think there would be some questions to consider in relation to how that is done. And that's because such entities don't have consolidated accounts. By definition, they don't have other entities to consolidate. So it would be helpful if this was an additional piece of legislation rather than made any changes to the existing consolidated accounts principles, which provide a very useful standard and a well understood purpose for other groups that are already reporting under country-by-country reporting. However, there is a practical point here which we think that the OECD might like to consider, which is that at least at the current threshold for country-by-country reporting, the number of large single enterprises with overseas foreign permanent establishments is likely to be very small. Certainly, that's our experience from the UK in terms of the number of such entities. So it may be worth considering how many such entities would be brought into the C/C reporting rules, and whether the time and effort to make that change is justified. But that's a practical point, not one of principle. And the final point, which is also a practical one, is that for entities that have permanent establishments, the financial information that would be used is probably, in many situations, that's which is already being used for tax compliance purposes, as opposed to information that is being prepared for financial statement reporting purposes. And that is, fine and accepted in the current guidance in terms of how the C/C reports are prepared. The only practical point on this is that often that information for tax compliance purposes may not be available until close to a local tax return filing deadline. That's just the way that the numbers are produced. And therefore there may in some situations be some merit in extending the deadline for filing the standard C/C report for entities that are doing this for a number of foreign permanent establishments, but not for local entities. Again, that's a practical point rather than one of principle. If we move on to the next slide. The second topic that we were asked to consider was around groups that are under common control but don't have an ultimate parent entity that's preparing consolidated accounts to produce a C/C report. I think this is a more difficult topic to consider for a number of reasons. Firstly, some practical points, but secondly, a question of what additional benefit would it bring to the tax authorities to put together some of these disparate groups. So the first point is that in some circumstances, there are practical difficulties for businesses to get information in relation to other groups and businesses that they do not control. And that is a point that needs to be, I think, recognised in terms of what we're asking groups to be able to get. And as a result, if we are going to make any changes here, there would need to be strong evidence of the usefulness and the proportionality of asking for groups that aren't under that degree of common control at the consolidated accounts level to prepare additional, get and ask questions to prepare additional information. So the question then again is how many affected organisations would be in this category? And therefore, if there are a significant number of affected organisations, it may justify making this change. If there's only a small number, perhaps this is a change that would be not necessary at this time. The other question I think we need to consider when looking at this is what is the level of transfer pricing or BEPS risks for groups that are under common control but don't form part of the same group. And it may be the case that the BEPS and transfer pricing risks are lower between those two groups, not within those groups, but between those two groups, because they are typically groups that are highly divisionalized. They operate with separate management, with separate finance functions, usually in different industries undertaking different activities. There isn't a common board of directors, and there is likely to be a much lower scale of controlled or related party transactions between them. So the question then is the level of transfer pricing or BEPS risks the same when you're considering those two groups together, as opposed to considering them independently? And it may be the case that questions under tax audit may be an appropriate and proportionate response to any questions that come up in relation to those situations, rather than requiring them to be reported on annually separately. If we move on to the next slide. If we were to make some changes to the control test, so to move away from the consolidated accounts basis of control, then I think that test would need to be simple, because it would need to provide certainty to businesses and to tax authorities and to be cost effective. And in particular, there are some existing complex control tests, which are typically anti-avoidance tests in domestic legislation, but those are likely to be overburdensome in this situation because they are very specifically focused on anti-avoidance, and that is not the situation that we're looking at here. Instead, we are looking at groups that are owned under common control, but not as part of a group. There is also the question around the rules applying to the investments of widely held collective vehicles, and it's acknowledged in the OECD paper that they do not pose the same transfer pricing risk. I think we would agree with that. There is a question about whether the reference to widely held collective investment vehicles is needed, as all collective investment vehicles are considered by reference to the standard C/C rules, and you consider the accounting standards for consolidation in determining whether they should be an item that should be brought within a group's C/C report. And I think finally the point is that we've talked a little about the difficulties or the burden on businesses, and there's some debates about what is appropriate or not. Just one practical point is that the finance functions of groups that are under common control but not part of the same group are not likely to be integrated. So there may be considerably extra additional work that might be needed for those groups to produce the C/C report. And then finally, one of the suggestions is that there could be a lower revenue threshold for groups that are under common control. And it's not immediately clear to us why a lower revenue threshold for those groups would be appropriate. Instead, whatever revenue threshold is considered appropriate for C/C reporting in general should also be applied to groups that are under common control. Thank you very much.
Thank you, Ms. Loeb, for your very good input especially from the practical point of view. Okay, the last speaker is Ms. Eva Luti, a transfer pricing team at Schroders, representing European Business Initiative on Taxation. Ms. Luti, the floor is yours.
Thank you, Chair. Thank you for the opportunity to comment. My name is Eva Luthi, and I'm here to represent EBIT, the European Business Initiative on Taxation. I'm the transfer pricing lead for compliance and analytics at Schroders Investment Management, a member company of EBIT. On the first question, and as you can find on the first slide, regarding single enterprises with foreign PEs. As has already been mentioned by other panelists before me, it would be consistent for single enterprises with foreign permanent establishments to be considered a group for the purposes of CBC reporting. In our view, the issue of permanent establishments is already covered by the model legislation related to CBC reporting and similar articles in the competent authority agreements in the BEPS Action 13 report. These articles define an M&E group as including an enterprise that is resident for tax purposes in one jurisdiction and being subject to tax with respect to the business carried out through a permanent establishment in another jurisdiction. From our perspective, we do not think that changing the definition of group would bring in any new data, as we consider single enterprises with PEs to be covered already under the current definition. Regarding the second question, and moving on to the next slide, on groups under common control. As Alison Lopp from Deloitte already mentioned, this change would require businesses of all sizes to request shareholder information they do not necessarily have in their possession at the moment, and there is no legal basis for this data having to be provided. Also, we could expect that only a small number of groups exist which would fall in this category. Therefore, there's a real question here of proportionality of this change and usefulness of this additional information, given the practical difficulties of obtaining the data. There might be better ways for tax authorities to obtain the relevant information, for instance, through audits. In terms of the definition of control, this would have to be tightly defined to meet the policy objectives. So the definition, of course, would have to be such that it catches the relevant groups under common control. But at the same time, care will have to be taken to minimize the new scope of that test, so that it does not bring in investment structures which are outside the policy scope. The concern identified appears to be related to wealthy individuals and families, and any solution should therefore be targeted at this specific problem. A poorly defined control test would be of particular concern to investment vehicles that take a number of legal forms. The OECD public consultation document acknowledges that this should not apply to investments of widely held collective investment vehicles, as these do not pose these transfer pricing risks. We agree with this and would like to draw the attention to the fact that widely held collective investment vehicle is not a defined term, and there is no apparent reason as to why the exclusion would not be applied to other investment vehicles as well. Thank you, Chair. Thank you for your attention.
Thank you, Ms. Luti, for your valuable inputs. Once again, I would like to thank all speakers for your contributions. Now I would like to open the floor. As I said, these topics are a little bit more technical than yesterday's topic, so it may not so be easy to discuss deeply, but I'd like to encourage all the participants to raise your hand and express your view. Can make the flags. So I have just one question to the speakers. As some of you said that number of entities or number of groups will be affected by these two possible changes would be small. That may be good for the change, but that may not be good for the maybe effective, not very effective. So how do you balance? How do you evaluate the possible small size of the groups affected? Can you hear me? Can you hear me better? Ms. Roth, please. Sorry, I don't hear you. No? It's only me?
Alison, we can't hear you.
Is that better?
Oh, yes.
Perfect. Sorry, apologies. Thank you, Chair. I was just going to say that in relation to the comment that I made on single enterprises with permanent establishments, that in our experience there may only be a very small number of these. I agree, Chair. If this is something that you make the change and it doesn't, it meets the policy objectives, but doesn't necessarily mean that many more people have to do it, then that it may be a balance that you decide is the right answer because you wish to receive that information. I think the only reason I made that point was that in terms of you know, the need to go through the process of making changes both at the OECD level and then in countries' domestic law implementing the C/C rules, it may not give tax authorities very much more information. There may be very few additional reports that are filed and shared in relation to such entities. But if, you know, nonetheless, if there is a concern that tax authorities want to receive that information, then by all means it could be done. Thank you.
Thank you. Any other thoughts? Italy, Mr. David Pitalo, please.
Thank you, Mr. Chair. Just a question or a request for suggestions to the business, and it is about the common control. They said that in case there is a common control kicking in, it should be a common control test that is very easy to apply, and we were wondering whether they had any suggestion. Consider that on the top of the chain there might be an individual, a family, or a vehicle who's acting on behalf of the individual and families. So if they had any easy way to make up this common control text in a practicable way. Thank you, Chair.
I can see the flag here, so I just go to the order of the flag. So Emmanuel is Nigeria, please. I don't know, Mr. and Mrs.
Hello, thank you, Chair, for the opportunity to talk. Mine is a comment. Comment on the first presentation by Oliver Lally for Irodad. From a developing country perspective, I want to align myself with some issues she raised, and the issues that have been raised on the same topic yesterday. There's a reason why developing nations are finding it difficult to meet the threshold to start receiving information. Part of this reason, apart from technical challenges, include the cost of procuring the processes and the infrastructure needed to meet the confidentiality threshold in BEPS Section 13 and the CBCR generally. From a developing country perspective, it takes between 1 million to 2.5 million US dollars to put all this infrastructure in place. And I know, even for countries like Nigeria, this is pretty big cost. And if, as a tax administrator, you take this up to your political head, and you tell them you need to expend 1 or 2 million on infrastructure, the question will be, what is in it for us? What is immediately coming back? And that's why it becomes important that the call for the threshold to be reduced be really taken seriously. Because if we do not see that if we spend all these costs that we have access to these information, then the politicians on one hand may not be willing to put in the money with which you put the infrastructure in place. That's one. And again, I also want to call, just like many others have done, that the OECD and the parties working on this project should have a closer look at the GRI standard and see whether it could present alternative to some of the challenges that we are now currently having trying to implement this VCR. Thank you, Chair, for the time to talk. These are my view for now. Thank you.
Thank you very much, Mr. Hayes. So, Ms. Loeb, could you make some comment on the Italy's comment?
Yes, thank you, Chair. So yes, just to comment on the question from Italy around a control test. I think the simplest route and the easiest one, at least to start with, would be to use a more than 50% shareholding, ordinary shareholding test to show where there is control. I think other tests that are more complex may be difficult for groups to, and particular individuals or family groups that may have a number of different businesses that they own, to make those kind of decisions easily and quickly. Now, that it is recognised that that test doesn't cover everything in relation to situations of control, so it may be that there may need to be more complicated tests considered at a future date. But my preference usually would be to start with a simple test and then see whether it does actually produce the information that makes sense for tax authorities to see, and then reflect on that at a future point if it turns out that there is something more complex that is required. Thank you.
Thank you very much. Now, Ms. Lari, do you have any comment on the Nigeria's comment?
Thank you, Chair. I'd like to first of all, I think, welcome those comments, Mr. Easy. I think it's very helpful for us to understand the experience, and we do understand that Nigeria has been in a non-reciprocal state, and that there have been recommendations made in the peer review, and we follow these, of course, very, very closely. I think the point and threshold is incredibly important in ensuring that this works, and I do think, given the significant experience we have from the banking sector, we can also address many of the risks that were originally raised when the analysis was done in advance of the implementation of BEPS Action 13. So I think there's a huge amount to build on, and I think it is important we listen to this. Equally, I do think that the point that Mr. Easy makes around the political willingness to invest is very important, because of course these are political decisions and we face resource constraints, and this is especially true at the moment as we face an economic crisis. And for this reason, we really believe that public reporting is absolutely essential, because this ensures that all tax administrations and all governments have access to this information, which can motivate political will and equally ensure that developing countries do not have to invest very significant amounts of money in systems that they haven't chosen to do for their own domestic reasons, but rather in order to access information. So I think they're very important points, and I really echo them. And I think that the public nature of reporting is fundamental to accessing reports for all developing countries. Thank you.
Thank you very much. Now I would ask Ms. Abinport for your reaction, please.
Yes, it's answering a question from Italy, David, that as Alison mentioned, we think to face these families controlling different businesses and without a consolidated financial statements, we have like two steps. One, that is identification. If we reach the threshold, that is the first step, and will be difficult because we have to add all this participation over a 50%. And after we have the second part, that is that one that we pointed in our presentation. That is, if we made these families report all this information, will be impossible for them. So we think that the filing obligation should be for the controlled group of entities, just identifying the ultimate parent entity. Because if not, obviously it's impossible. There is a lack of information in these families to know all the data to be reported in the CBC. Thank you.
It's just me.
Sorry, now I have a flag of Mr. Doholi of Indonesia, Mr. T Kivi.
Thank you, Chair.
Yes.
Okay, thank you, Chair, for the opportunity. My name is Kivi. I'm from Indonesian Tax Authorities. I concern about the possibilities when an M&A group could restructure the group, maybe by splitting its subsidiaries into several groups. And in such condition, the M&A group can avoid the obligation to file CBCR as it doesn't meet the threshold. However, to deal with this issue, I just imagine what if instead of require the taxpayer with revenue below CBCR threshold, but under common control to prepare CBCR, what if we expand the scope of constituent entity? So besides the definition of constituent entity as already stipulated in Action 13, we can include the definition of constituent entity as any entity which is directly or indirectly consolidated by ultimate parent entities, or any entities which is directly or indirectly under control of ultimate parent entities, or any entity that conduct affiliated transaction among group members, either being consolidated or not consolidated by ultimate parent entity. So we do not have more CBCR, but we have the same number of CBCR, but with larger scope or with more constituent entity. Thank you, Chair.
Thank you very much, Mr. Kiwi. Now I would like to turn to the speakers. Anybody who would like to respond? Okay, before that, I have a flag of Mr. Dem Blecker. Floor is yours. EY.
Hi, good morning. And can you hear me?
Yes, I can hear you.
Great. I would like to comment on the point of consolidation versus common control. I think the points that were raised by Alison Locke of Deloitte are very relevant because there's an important question on the usefulness of the information at the moment that you consolidate various business units that are involved in different activities. We have a number of examples of sovereign wealth funds, for example, that invest in an airline company versus a hotel chain, and then the third business unit is oil and gas. If you focus only on the common control and you would consolidate these business units in one CBC report, I think the usefulness of that will greatly reduce. If you think about the purpose of the CBC report being high-level risk assessment for transfer pricing purposes, I think the usefulness of the report will go down significantly. Thank you.
Thank you very much. Ms. Abuin Porto, please.
Yes, just related to this comment of Ronald, this is not only a problem of controlling groups, because also consolidated financial statement entities can have very different investments and very different line of businesses under the same consolidated financial statement. So if you are thinking in making ratios to compare between the same business industries, also we should rethink the threshold and that we should divide information in business lines, because it's a problem that we can also face in consolidated financial statement groups.
Thank you very much. Now I see more flags. Mr. Picciotto, please.
Yes, thank you very much. I just wanted to introduce a clarification. I think it was just said that the purpose of country-by-country reports is to identify high-level transfer pricing problems. But actually, it's broader than that. It's part of the whole BEPS project. And the purpose is to identify all issues of base erosion and profit shifting, to identify how far income is declared and tax is paid in alignment with the activities in each jurisdiction. So it's not about just transfer pricing. The point we made quite strongly yesterday, it's a general transparency tool for the general public and stakeholders, as well as national tax authorities, and it goes clearly beyond simply issues of transfer pricing. It's to introduce transparency as to how far there is alignment between substantial activities in jurisdictions and the tax paid in jurisdictions.
Thank you. Now I would like to request that Mr. Grindes, floor is yours.
Good morning, sir. For your time. I have a question about concerning some issues for CBC reporting. For example, offshore company when they don't resident or they aren't resident in one state. That is a issue, for example, to implement in CBC reporting, because you can this kind of activity or this kind of taxpayer don't be resident in any state. Maybe it's one question you need to talk in the future or in this discussion in public consultation. Censure.
Mr. Grindes, I'm sorry, your sound is not very clear, so could you repeat your question again?
Yeah, of course, sure. For example, you need to review, for example, offshore company. We can't make in the scope on the CBC reporting because they don't be resident in any state. Offshore company.
Yes, you're talking about offshore company who is not resident anywhere in the world. So yes. that is yeah. Status company, and that is another topic maybe we can discuss.
Sure, thank you.
All right, thank you very much. Now I don't see any more flag. So I would like to thank again to all the speakers, and I would like to close this item, and I would like to move on to the next item. Okay, the next item is item 6. This is last item for the topics related to the scope of CBC reporting. The topics to be discussed in this item are, there are 4 items. 6A, should the threshold for the excluded M&E groups take into account more than 1 year of consolidated group revenue? 6B is, should extraordinary income be included in consolidated group revenue? 6C, should, the same kind of questions, should gain from investment activity be included in the consolidated group revenue? Lastly, 6D, in case where the immediate preceding fiscal year of the M&E group is of the period other than 12 months, should the consolidated group revenue threshold be adjusted in determining whether the M&E group is an extended M&E group or not? These topics correspond to the question number 16 to 26 in the consulting document. Like previous item, I would like to first invite the lead speakers to share their views on these issues. The first speaker is Mr. Carl Berling. I think you made it already.
Yes.
He is Vice President, Head of Tax, ESTED. Mr. Berling, the floor is yours.
Thank you, Mr. Chairman, and hello to everyone. I represent Ørsted, and we develop, construct, and operate offshore and onshore wind farms, bioenergy plants, and provide energy product to customers. And I think in this context, it's very important for me to clarify that when I talk about offshore wind farms, it's nothing more exotic than that the wind turbines are placed at sea. The companies are very much resident in the jurisdictions where we operate, which is primarily Europe, North America, and Asia Pacific. I will be a bit daring and actually try to do this presentation without a PowerPoint, and I will also be fairly short and sweet. I will actually start with 6A and 6D together and then deal with 6B and 6C together. When it comes to the threshold for excluded M&E groups, we're not an excluded M&E groups, but I can have a position anyway. And whether it should take into account more than 1 year of consolidated group revenue, I think it makes very much sense to look at an average of, say, 3 years to look at whether an M&E group is excluded or not to have unwanted effects from freak years or unnatural years. And in cases where the immediately preceding fiscal year of an M&E group is other than 12 months, it could be a prolonged or shortened accounting year, or it could be a different accounting year, whether the consolidated group revenue threshold or the group revenue in the immediately preceding fiscal year should be adjusted. I think what does make sense is to actually follow the actual fiscal period and treat that as one. So whether that is 6 months or 18 months, I think you treat it as one fiscal period rather than trying to adjust. When it comes to whether extraordinary income and gains from investment activity should be included in the consolidated group revenue, our position is very clear, and it is that it makes very much sense to include that in the consolidated group revenue because tax payments or non-tax payments might certainly be linked to extraordinary income and gains from investment activity. So there is a legitimate interest, I think, both from companies and from other stakeholders to have a look at that and to be able to see that. And when I talk about tax payments linked to extraordinary income or investment activity, that is of course one thing that is interesting, and also of course non-tax payments where the extraordinary income or gains from investment activity is excluded or exempt for some reason, I think it makes sense to provide information or to be able to determine whether the exemption of the gain or the non-taxation of the gain or the extraordinary income, is that due to an accepted exemption regime like the participation exemption regime, or say a shipping tax regime, in a non-harmful tax practice, or is the non-taxation of the extraordinary income or the investment activity a result of harmful tax practices? So I think, to sum it up, it makes very much sense to include both extraordinary income and gain from investment activity in the consolidated group revenue, so that one can also determine tax or non-tax payments from those. And with that said, I think I have made my points as clear as I could. So that would be all for me for now. Thank you.
Thank you very much, Mr. Berlin. Very, very clear message. Now, a second speaker is Mr. Oliver Herman, a senior tax counsel at 3M, representing the Tax Executives Institute. Mr. Herman, the floor is yours.
Thank you, Mr. Chairman. I'd like to introduce TEI first. Tax Executive Institute is an association of in-house tax professionals. It has nearly 7,000 members across North and South America, Europe, and Asia, and they represent about 2,800 companies from all these geographic areas. TI wants to thank the OECD and the Inclusive Framework for preparing the consultation document and providing us with the opportunity to make comments. TI is really well suited to make comments because many of our members are actually involved in the preparation of the country-by-country report in their companies, and therefore has the practical hands-on experience. Generally, TI recommends that changes to the current CBICR be limited to those absolutely necessary to ensure the function of the CBICR of being a high-risk assessment tool. And to keep in mind the balance between benefits and cost. Yes, our companies have a lot of data, but pulling data and putting this data in a report like the CBICR, changing the format of this report, means designing a process that will ensure that the report is accurate. And that requires resources, efforts, and costs. Now I'll cover the 4 questions. So if we can go to the next slide, please. So on the question on whether 1 year or more than 1 year should be taken into account to determine the threshold, TI supports the proposal to use more than 1 year. That would reduce the volatility that may be caused by certain unusual events, like currency fluctuations or mergers, acquisitions, and divestitures. We think that using 3 to 5 years would be reasonable. There were 3 options proposed in the consultation document. Option 1 seems to be simpler and therefore has our preference. It would be, in addition, it would be good to have more guidance on the definition on revenue in order to ensure consistency and comparability. Next slide, please. With respect to whether extraordinary income should be included in the consolidated group revenues. First, we note that extraordinary income must be included in revenues reported in Table 1. So if consistency is deemed to be important, it would support the inclusion of extraordinary income in consolidated group revenues. In addition, there is not one single definition of extraordinary income. Definitions vary across accounting standards, so including extraordinary income may increase comparability across multinational groups, while excluding extraordinary income could lead to controversies with countries where a local secondary filing may be required. And those countries may not agree with the definition of extraordinary income of the parent company's country, for example. Now, this being said, extraordinary income does not reflect the recurring operating income, trading income. So including extraordinary income could cause a group to exceed the threshold in 1 year, have to produce a report in 1 year and not in the following years. And extraordinary income is not necessarily an indicator of profit shifting. It may be perfectly legitimate income. So these points could support the excluding extraordinary income from the group revenue. So in conclusion, either approach can be supported. It's important to have clarity on what extraordinary income is, and also to ensure that extraordinary losses, there's also guidance on it, and that this guidance is consistent with extraordinary income. Next slide, please. So the same question with respect to gains from investment activity. And here, there's a definitional issue first. What does gains from investment activity mean? The term gain would intuitively make us think that it's the gain on the sale of an investment, but the consultation documents seems to include interest income, dividends, so not just the pure concept of gain, but a larger concept of income, the definition. Also, another questions that in-house tax practitioners face, are we talking about gains or loss, or are we talking about proceeds? So I think that here, clarification of what gains from investment activity or other terminology, but again with a clear definition, is really needed to help understand what needs to be included in consolidated group revenues. Again, if consistency with what is reported in Table 1 is important, so it would support the inclusion of gains from investment activities, whatever the definition is, because they clearly must be included in the revenues in Table 1. One comment on something that's specific to US-based companies, the US Treasury regulations state that dividends from constituent entities are excluded from revenues. So we would encourage the OECD and the inclusive framework to look at this exception and consider it because it may, if it was adopted, it could increase consistency across all reports and therefore comparability across multinational groups. Investment activities may not part of operating activities of a group. Therefore, the inclusion may cause the group to be subject to the C/CR in 1 year and not in the following years. However, if a multi-year approach is used to determine the thresholds, that may be a way to resolve this difficulty. So to conclude on this point, the first definitions must be clarified, and the inclusion of certain categories of gains of income in the consolidated group revenues must be driven by comparability, the goals of comparability, consistency, and neutrality across all multinational groups. Next slide, please. So the last point relates to whether an adjustment should be made when a multinational group's fiscal year is different than 12 months. And our recommendation is yes, absolutely. Such an adjustment is needed to ensure consistency and neutrality across all multinational groups. And there were several approaches proposed in the consultation document. The third approach seems simpler and therefore preferable. So it consists in adjusting the threshold rather than adjusting the consolidated group numbers. One caveat, we agree, on the proposal, and we fully support the proposal to make this kind of pro rata adjustments, but only when it comes to looking at the fiscal year of the group. There may be situations where certain constituent entities have a fiscal year or are included for less than 12 months and for valid reasons, for example, acquired or divested entities. So there should not be further adjustments when a constituent entity is included or has a fiscal year for less than 12 months, because that could actually lead to double counting when a constituent entity that was divested or acquired, belonged to another multinational group. And that concludes my comments. Thank you.
Thank you very much, Mr. Hamann. Now I would like to turn to the third speaker, who is Mr. Sol Picciotto. I think all of us already know you very well, but just I would like to say that you are the coordinator, BEPS Monitoring Group, and the Emeritus Professor at Lancaster University, UK. Floor is yours.
Yes, thank you very much, Mr. Chair. Well, maybe you and quite a few others might know me, but I will just say that the BEPS Monitoring Group, which I represent, is an international network of researchers independent of both business and government. I generally appear as the front man, if you like, because I happen to be retired, which gives me a lot of time to participate in these activities. So on this particular point, on these points rather, our first point is that, okay, next slide, that's it. I only got one slide. I got all the points onto one slide. These issues really are significantly affected by where the threshold is set. So if we had a lower threshold, as many have argued, the problem of a cliff edge effect is less salient. One of these issues I think a key issue in all of these matters we're discussing in this session is the cliff edge. That once a company is included in country-by-country reporting, does it then drop out? And that I think would be less problematic if the threshold were lower, and strong arguments for making it lower, as has already been pointed out. We appreciated the comments from the member from Nigeria, that for developing countries, Nigeria obviously is a large developing country, but even for Nigeria, but for smaller developing countries, 750 million euro turnover is really far too high. Now that the country-by-country reporting system is well established, there seems no reason not to reduce, to scale it up, to reduce the threshold. I would point out that in many African countries, for example, the definition of large business kicks in at around $4 million turnover, so it's a lot lower than 750 million euros. So there must be a serious consideration given to lowering that threshold, which would, as I say, make this problem of the cliff effect less salient. On the first point in this session then, variation between years, it's very important to bear in mind that in addition to high-level risk assessment of individual companies, the aggregate data will be used for statistical analyses and so on. So I think for both those purposes, it's important that once a country begins reporting, it shouldn't drop out of reporting simply because of blips from one year to the next. The need to avoid reporting gaps suggests to us an alternative that isn't suggested in the consultation document. What we would suggest is that once a firm is over the threshold, then it should continue to report unless the average, let's say a 3-year average, falls below a percentage of that threshold. We would suggest 80%. It's likely that once a company, a firm reaches the threshold, that it would continue above the threshold, but there may be fluctuations, for example, due to currency differences from one year to the next. So in order to avoid those reporting gaps, we'd suggest that once over the threshold, you stay in as a reporter unless a 3-year average dips below 80% of the threshold. Then on the other 2 points, we would agree, I think there seems to be a significant unanimity on this panel. Extraordinary income should be, it should be clarified that extraordinary income should be included in the reporting. It's unlikely that it would make a very significant difference to the threshold, but it is important. There are differences between different countries as to what the definition of extraordinary income is. But whatever extraordinary income is, all income should be reported. Next, also in relation to investment income, and I appreciated the comments of the previous speaker to clarify what actually is meant by investment income and the differences between gains and income. If income is the wider term, then clearly income should be used, income or gains. Maybe a better way, but the more clarity the better, because as we stressed in the presentation yesterday, the OECD's key role should be to ensure the quality of the data. So the more clarity in the definitions, the better from the point of view of the international use of this important standard. Thank you very much, Mr. Chair.
Thank you very much, Mr. Picciotto. Now I'd like to turn to the last speaker, who is Mr. Ben Semper, a Transfer Pricing Director at Mazars.
Great, thank you. Thank you, Mr. Chair. So yeah, my name is Ben Semper. I'm from Mazars, based in the UK. It's a pleasure to be talking to you all today on behalf of the Mazars Global Tax Leadership and also the Global Transfer Pricing Steering Committee at Mazars, of which I'm a member. I'd also like to pause again just to thank the OECD's work here, and also more generally, I think the way it brings together all these different interested parties in a collaborative way to find consensus really is excellent. In our own small way, we've looked to follow that great example within Mazars, and we've reached out to interested parties across the 91 countries in our integrated partnership. And what we've looked to do is sort of best represent our clients, which range from the very large listed companies through to the mid-tier, and also multinational enterprises, the sort of smaller individual companies as well. And I think it's important to remember actually that the vast majority of international enterprises want to do the right thing. They want to be compliant, and one of the comments I made yesterday actually is that they want to maintain trust of all stakeholders in the community. But we have to remember that a lot of these organisations may not have big finance teams. They've got finite resources, and so the comments that a number of my colleagues in practice in these presentations have made, and Mr. Herman has made as well. I think it's always important to remember that we need to strike the right balance between maximising the benefits of the reporting and the material benefits, against the changes and the implications of those changes. You know, increased complexity probably doesn't help anyone in interpreting the data. So thank you for moving the slide. So with that in mind, I wanted, before moving on to the answers to the questions posed, is just sort of frame our approach really in our response. So, you know, I've made the point there around the increasing burden, and it's across transparency. You know, we must remember the general framework for multinational enterprises is, probably rightly so, is very different to what it was at the beginning of the BEPS project. We welcome any refinements that improve the presentation and interpretation of the CBCR information. Again, getting global alignment to procedures and notifications. Wherever you've got differences in country approaches, again, that increases complexity and the compliance burden. And we have to remember some of the penalties actually for non-compliance with the CBCR are actually quite large. So it's important for a number of reasons that our clients can get this right. And the final point there, as we say, and again, I think it's been recognised by all parties actually, which is great, that the CBCR is just one tool for risk assessment purposes. And there's been lots of sort of conversations and debates around the use of the CBCR, but you know, fundamentally, I think it's true to say that its current design is part of a three-tier approach to transfer pricing, with the intended audience currently being tax authorities. And so it's with that, in that context, that we've approached our responses. So if we can move to the next slide. So the first question around this sort of threshold for reporting, and again, I think with all the panelists, you know, we would agree actually this seems an entirely sensible move, and we are in favour of a multi-year approach to reporting. Again, I think common with the other speakers, a 3-year average of consolidated revenue seems very sensible. And it does sort of prevent and protect from some of that volatility, and also, you know, provides a balance of transparency and continuity of data capture, I guess, with companies not dropping in and out each year, perhaps. It may be a few companies, groups at the periphery, but I think it's an important proposal. So if we move to the next slide. So we've grouped 6B and 6C together here, and at risk of breaking the consensus that was perhaps noted in the last presenter, we're not actually in favour of these measures, and I'll perhaps explain why. So I think, as Mr. Herman, I think, rather eloquently put, you know, there are complexities in defining these two items. And these two items are in the context of considering the threshold at which entities will be required to report. So some entities will already be including some or all of these items as part of their consolidated group revenue, and you know, that in a sense is fine. If we move away from, you know, the basic principles of preparing CBCR data, which I think Richard Murphy again eloquently put yesterday, is accounting data. And I think if we move away from that into a more specific CBCR definition of consolidated revenue, it will affect everybody. So, you know, everybody will need to review their consolidated group revenue, whatever it is, and see whether it is consistent with the CBCR definition. So we're very much in favour of maintaining an accounting data set of principles for the CBCR threshold. Again, it is the threshold that we're considering here. The other point, I think, is if it is included, you know, whilst the averaging of data will assist, you know, inevitably there will be increased volatility in measuring against the threshold. And again, going back to, you know, one of our principles that is framing our thoughts, this is a part of a 3-tier approach to transfer pricing risk assessment currently. a lot of the items that we're considering here may well be adjusted out for transfer pricing purposes. So it doesn't seem to be a great deal of merit in having a threshold that includes items that themselves perhaps have relatively low transfer pricing risk. Noting participation exemptions, capital gains exemptions, and the capital gains often aren't even within the scope of transfer pricing under local rules. And then again, I think Mr. Herman made a very good presentation on what we mean by income or gains. So, in summary, then, again, breaking perhaps from some of the previous presenters, we're not in favour of this. So, if we move to the next slide, please. Again, I can probably be sort of relatively brief in here. Again, I think probably this may have been an oversight in the original rules. It seems, again, entirely sensible to adjust for short periods. In our response, we sort of considered mathematically that there may not be a great deal of difference between the two. So we weren't particularly in favour of either. But perhaps on reflection, and if we look at how thresholds are generally dealt with within tax rules, it's usually the threshold that gets adjusted rather than the data that you're testing against the threshold. And again, I think Mr. Herman made some good points there, actually in favour of adjusting the threshold. So perhaps on balance, the threshold would be slightly more preferential. So I think that's the summary of the points from Mazars. Thank you.
Thank you very much, Mr. Sempa. Once again, I would like to thank all the speakers for very valuable and interesting inputs. Before opening the floor, I was just informed that Miss Saulnier of MEDEF raised hand just at the end of the previous item. So if you may, I'm happy to give the floor now to you, Ms. Saulnier. No?
Can you hear me?
Yes. Please go ahead.
Sorry. Sorry. I raised my hand too late.
That was my fault.
Previous item. No worries. Sorry about that. I just wanted to come back on the common control, groups under common control, and just to make an observation that in the consultation document, there seems to be a variety of situations that were identified. Families controlling subgroups, but also conglomerates, wealth funds, and also the question of splitting intentionally groups to avoid CBCR reporting. So I just wanted to make the point that I was a little bit concerned that that there are a variety of situations identified, and just making the point that maybe they should not be treated in a single way. For instance, maybe an anti-abuse clause could be preferable rather than a change of rules if you want to address the situation of splitting groups. So I don't think that a general change of rule might be the best way to go forward. Thank you very much.
Thank you very much, and I'm sorry again that I missed you.
No worries.
Okay, now we'd like to come back to item 6, and Mark, do you want to clarify the situation here?
Yes, thank you very much, Chen. Thank you to all of the speakers for this panel. I just thought it might be useful before moving on to further comments, just to clarify a little bit of the thinking and background to the comments in the consultation document, specifically around the extraordinary items and in parallel the gains from investment activity, but I think in particular around the extraordinary income. Here, I think it is clear that when we're looking at table 1, so looking at the information that is being provided in a CBC report, then all items of income, revenue, gains should be included. And so when we're talking about whether or not to include or exclude extraordinary income, that the question isn't whether or not that should be reported, it's whether or not it should be included, taken into account when determining whether a group is above the threshold, and so whether or not a CBC report should be provided. And the concern that had been identified within the inclusive framework was because different accounting standards use different definitions for extraordinary income, and indeed a number of the major accounting standards have removed their approach to requiring extraordinary items to be separately disclosed, and so they are now included within normal revenue, that you could have two groups who are in the identical situation, but because of the accounting standards that they applied, one of them would be including a particular item and disclosing it as extraordinary or exceptional, whereas another one would be required just to include that as normal revenue. And so I think I apologize, I forget which speaker it was who made this point. I think that the options that we saw were that requiring extraordinary items to be included meant that groups who would have included an item of income as ordinary revenue or as extraordinary revenue would be being treated consistently. So whether you included this item within normal revenue or separately disclosed it, you would always be taking it into account. So that would address an issue of consistency. The downside to that approach is the issue which a number of panelists raised, that if you have exceptional income in 1 year, it could throw you above the threshold for that year. So it would introduce that issue, but at least it would introduce that issue for everybody. Whereas currently that issue exists for those that are applying accounting rules that don't have exceptional items, but might not apply to those that do have exceptional items if those aren't included. And so you kind of have this slight mismatch between one option raises consistency, but then causes perhaps another issue, whereas excluding extraordinary items would remove that other issue, but only for those that have exceptional items under their accounting standards. And perhaps, as was said, if that other issue, the idea of the blip where you go up for 1 year, might be addressed if we look at a multi-year threshold. But I just wanted to make those comments before moving on, because I didn't want, I was a little bit concerned that some people also thought we were talking about excluding these items from table 1, and that is not the suggestion in the consultation document. But thank you very much for giving me a moment to take the floor. Thank you.
Thank you, Mark, for your clarification. Now I would like to open the floor. Well, there are some similarities and differences in the position of the speakers. So I'd like to encourage all the participants to express their views, or if you have any questions, please ask the question. I have I have the hands up from Mr. Berlin. Floor is yours.
Well, thank you. I think Mr. Pommier has made a very, very good point in the chat that it could be very relevant to get a better picture from the tax authorities and how they use it. I think a key point is to ensure that any data requested as part of the country-by-country reporting must be aligned with and necessary to perform an accurate risk assessment by the tax authorities, and not really go beyond that. So it could be very valid to actually check in with tax authorities to see how they do use the CBCR. Then I would actually like to comment on the points made, whether to include or not to include extraordinary income and investment income or gains or whatever you want to call it. I think that the purpose of CBCR, as I see it, is to actually show a picture of income and tax payments across jurisdictions, and to argue that these would always or almost always be excluded from transfer pricing documentation, I think that is maybe to take too narrow a view. It would be easier also, I think, for corporations, at least from where I see, to actually include this kind of income and gain, and not have to make too many manual adjustments to what we actually report under IFRS, for example, whether it's a part of the revenue for that accounting practice, or whether it's presented differently for that practice. I also think that taking a step back and maybe looking at it from the tax authority's point of view, or other stakeholders, how that could be, it is, of course, or could be at least, of interest to see what kind of extraordinary income or investment income or gains have occurred in a business, and why have they occurred in that jurisdictions. And I do think, when then taking a step back into my own position, that we would certainly have an interest in showing the full picture and not exclude items based on sometimes more or less discretionary accounting determinations that might differ from jurisdiction to jurisdiction. Thank you.
Thank you very much. Are there any other views? I don't see any flag here. Interestingly, at least the first item, item 6A, all speakers say yes to this question. And I noticed that all the speakers mentioned 3 years. But I know that Mr. Harman said 3 to 5 years, but well, that includes 3 years. And also Mr. Picciotto suggested a little bit different mechanism to decide whether they are in or out. But still, you know, he was mentioning 3 years. So I could find some kind of, you know, consensus among the speakers on this point. And as for the last item, 6D, I understand that all speakers again have a consensus to say yes to this question. But there is a 3-to-1 difference as for the question B and C. So I would like to highlight what is your views on, especially on these issues. Mr. Picciotto, please.
Yes, I'd like to hear from the other panelists and maybe other participants in response to the clarification from the OECD. I think that was an important clarification, and maybe some of the comments that have been made didn't focus particularly on this question, that the inclusion of investment income and extraordinary item, or particularly, I guess, the investment income, but also extraordinary items, we're discussing here in the context of the threshold. The other point, maybe to pick up from the chat, it's a much wider point, but I think a good point has been made on the chat, that all this discussion has been about generating the data, and from the business side, the point's been made about that it does entail a certain amount of work, and that it would be useful to have some report from the OECD on how these country-by-country reports are used. Now, we have had an economic analysis, the use made of the aggregate data by the OECD to provide economic analysis in the current discussions, particularly on Pillar 1. But we haven't had really any reporting from the OECD on how countries have been using it, how useful, and what difficulties. To some extent, I think this discussion document is based, obviously, on the issues that tax authorities have had in making use of the reports. But I would support the comment on the chat that it would be good to get some report from the OECD on how countries are using the data and how useful it is to them.
Thank you, Mr. Picciotto. For the first question you made, maybe I should ask Mr. Senpa to respond.
Sorry, could you just repeat the question? Sorry.
Was that meeting? I mean, how far were your comments addressed to the particular issue that the OECD has now clarified, that the issue of including the extraordinary items and investment income, it really only bears on the question of meeting the threshold. I mean, the income is supposed to be reported anyway, but the question is, because of different definitions in different countries, that might affect which companies meet the threshold or not.
Yeah, so yeah, I think our views, hopefully as a sort of fairly clear in the presentation, was with the threshold in mind. So, you know, we totally accept that once you meet the threshold, you know, table 1, etc., you have to report the data. And, you know, if you're reporting as you have to your tax payments, it would be meaningless to exclude that data. So yeah, our thoughts were purely guided by the turnover reporting thresholds. And you know, we understand the point and the concern the OECD has on maybe disparity between some groups that do include this in their accounting definitions and some that don't. But you know, I'm a transfer pricing person, not an accounting expert, but I suspect there's a raft of other differences within the accounting terms that may cause concern, and I just pausing really with the premise that you know we should be using accounting data as the starting point, and the more we move away from that, the more we're introducing complexity that, as I say, will catch everyone, because everyone will need to consider whether their accounting standard meets the CBCR standard in terms of definitions. So that's the concern really that we have.
Thank you very much, Mr. Sempa. Now I'd like to ask Mr. Harman. I think you are going to talk about this point as well.
Yes, thank you, Mr. Chairman. Well, I'd like first to thank Mark Johnson for the clarification. It was very welcome, and to confirm that you know, the comments I made on behalf of TEI also focused on the threshold, and we never understood the question as whether there should the definition of revenues for table 1 should be amended or not. Just wanted to highlight that. As it was previously said, that there may be inconsistencies currently between what is reported as revenues in Table 1 and what is included in the consolidated revenues for determination of whether a group exceeds the threshold or not. And just wanted to you know, highlight the question of whether consistency is a driver for the OECD and in the inclusive framework in this respect. And as I said, I mean, TI supports consistency, comparability, and neutrality across all multinational groups.
Thank you very much, Mr. Harman. Now, Mark, could you respond to the second part of the question which Mr. Picciotto raised?
Yes, thank you for the question. So this concerns the use that is being made of CBC reports by tax administrations. And I think, understandably, given the sensitivity of how tax discussions that I have within tax authorities, it's very limited what I can say, certainly in this format, simply responding to a question from the floor. What I can say is that the OECD Secretariat has been working closely with a lot of tax authorities in terms of how they're using CBC reports. Now, to be 100% clear, no tax information, no taxpayer information is ever disclosed to the Secretariat. And I often say that it sometimes feels slightly ironic that as head of unit with responsibility for dispute prevention and CBC reporting, I'm probably one of the few people in this space who has never seen an actual CBC report. I never get close to taxpayer information. But I have been having conversations about how CBC reports are used. And I think that the story is mixed. There are a number of tax administrations that have made significant progress in terms of either incorporating CBC reports within their tax risk assessment frameworks, or perhaps running parallel risk assessments to see how they would view comparable groups, taking into account CBC data and not taking into account that data to see what changes come as a result of that. And we're working with those tax administrations to try and distill messages and learnings that we can then share with other tax administrations who perhaps have taken more time in terms of getting familiar with the information. We're also providing a number of tools to tax administrations to support them and encourage them to use it. At the end of the day, as we heard from Nigeria and we've heard from stakeholders on both sides of government and business, Action 13 has entailed a significant investment both for countries and for groups. This information is now in the hands of many tax administrations, and we want to be able to use it. After making all this money, we want to get people to make the most effective use of it we can. So, we produced the risk assessment handbook for tax administrations. That was a couple of years ago. We've been working with tax administrations again about how they can use CBC reports, not to be kind of determinative, but to indicate where there may be areas where questions should be asked, where substance doesn't seem to be aligned with the results of a group, and looking at particular transfer pricing risk. We're also looking at developing actual software, Excel-based tools that will be able to read the CBC report in an XML schema format, and again, not draw any conclusions, because ultimately that's for a tax administrator with their skill and experience, but to allow them to read the data. Some CBC reports, as we've heard yesterday, contain many thousands of entities in over 100 jurisdictions, and this is new data and can be overwhelming to a reader. And so we're looking to produce tools that will help them to distill that and interpret that. So I think, I can answer that question from two sides. One, in terms of how the OECD is working to help, but in terms of what countries are actually doing, all I can say is some are being extremely active and finding this information very useful. Some are perhaps moving slightly more slowly. What we are seeing from probably all jurisdictions is where there have been challenges and where there were problems in the data. Some of that is the responsibility of perhaps the way the original standards was drafted, that there has been a lack of clarity. We had to put guidance out recently to say that going forward, dividends should not be included within profit before tax, because if you're looking at effective tax rate figures, whether or not dividends are included can be highly distortive. That was an issue for the first years. We've now corrected that, but the nature of the beast is that information, that clarification will only come through in the future. So, that's one thing. We also have some things where perhaps, again, because it wasn't clear, M&Es are just reporting information differently. We've put out on our website a list of what we refer to as common errors in CBC reports. So things where groups have been excluded the last 3 digits, the last 6 digits from numbers, which makes it very hard, particularly when risk assessment is moving into more automated phases, to use those numbers if they're being prepared on a different basis. I'm also in the process of, just so that you're all fully up to date, we're also working on draft guidance currently around the use of negative numbers in CBC reports, because M&Es have come and said, if we're in a particular situation, we don't know whether this number should be being reported as a positive or a negative value. And again, if you're looking to interpret data and you're looking at one number, whether it's positive or negative might be quite different and might have a big difference in your view. So we are trying to learn as much as we can from the tax administration experience in terms of how we can improve the data, then get that out to you so we can improve the quality of CBC reports. And hopefully, again, that will mean that the CBC reports can be used more and more effectively going forward. That was quite a lengthy response, probably didn't contain the kind of clear determinative numbers that you may be hoping for, but at the end of the day, this is a risk assessment tool, and I'm not sure, hand on heart, if we're ever going to be able to get to the point where we can say these were the determinative outcomes as a result of a CBC report. Because at the end of the day, a CBC report should only be used as a trigger to ask questions and to guide further inquiries. Any conclusions needs to be driven by the outcomes of those inquiries. Thank you.
Thank you, Mark. Is there anybody of a country delegate who can share your experience of use of the CBC data so far? No hands. Well, I myself is now in the Ministry of Finance, and I'm not in the tax administration, but I have some experience, and I don't have first information right now, but I heard something about Japanese experience here. I understand that we have just just 1-2 years of data, and CBC data is very high level, so you cannot get into almost anything. You cannot get almost anything from the data itself. So what you can do is you compare with that data with the data that already tax administration has. They compares with this data and check them each other. Then you can find some questions, and you can find some doubts, and you can some suspicious point. So it may be difficult, as Mark said, whether the CBC data itself is useful or not, but it should be useful if you compared with the other data. And another point is, if you accumulate CBC data more years, you can compare it with year by year. Then you can find something else. Now I understand that the tax administrators have just one or 2 years, so it is too early to compare with the data each other. So maybe more years come, the value of data will increase. That's my sense. But maybe I should get more, first level experience from the country delegate. But I have a flag from Ms. Lally. That, please.
Thank you, Chair. At risk of stating the obvious here, I think it's important to be mindful that when we're discussing the experience of tax authorities in using CBC data, of course, we know that many tax authorities haven't had access to this yet. And I think it is really important to consider that then the experiences we have, and I have heard many experiences from tax authorities who have used this, particularly in integrating with existing risk assessment. But of course, there is a skewed nature to the experiences we've had towards high-income countries who've had greater access to reports. And so I think when considering how tax authorities can use this data, we absolutely have to address the question of access and making sure that developing countries, and especially lower income countries and small countries, also can access data and that their tax authorities can use it. Thank you.
Thank you very much. Now I see the flag of Mr. Muir of Oxfam, please.
Hi, yes, Daniel Muley. I just wanted to echo and build on the comments from Ms. Lally. I think it is really important that, as I've noted in the chat as well, that we do get additional information on how data is being used. But I do think that it is limiting if we are considering how data is being used solely by tax authorities, given the vast number of comments submitted to the OECD and mentioned over the course of the last 2 days in favor of making this information public for the utility of a much broader array of stakeholders, including other government bodies, lawmakers, civil society, and investors. I think we've heard a few people note the difficulty that tax authorities in developing countries are having accessing this information. That is one place where civil society has particularly stressed this information would be extremely useful. But looking even beyond that at this broader array of stakeholders would indicate that there are other uses of this sort of information that should be considered. And so I think we've heard a lot from a number of folks over the last 2 days about compliance costs as well. And while I don't mean to suggest by any means that we should minimize them, I think it's important that we do understand those. I think we're presenting, whether intentionally or not, a sort of false cost-benefit analysis here. If we're talking solely about the cost of developing country-by-country reporting, as compared to the benefits in terms of the utility thus far for the tax authorities that have had access to that information. That's just not the full range of stakeholders who see value in this information. And so I want to make it very clear that is not a comprehensive assessment of cost-benefit of the country-by-country reporting data, and that can only really be fully judged after this sort of information is made public. Thank you.
Thank you very much for your input. I don't see any other flag. I would like to encourage country delegates to say something. This time I don't want to miss anybody, so I would like to wait a little bit more. Nobody would like to say anything more? Yes. Mr. Kimani of Kenya, please.
Thank you. I would just like to talk about the issue of the threshold in terms of what Seoul has introduced and what Nigeria has said. And for developing countries, it has been a problem for us even trying to advocate for the passing of the legislation for CBC, because now the government is looking at what would be the impact, and looking at the threshold that has been put of 750 million and comparing that to the performance of the MNEs which are within our jurisdiction. Our large taxpayers is close to almost 7.5 million euros. And they are looking at what kind of information would we get if we then legislate this new CBCR requirements. So that has been one of the main issues in terms of whether we will get on board as per what our treasury is telling us. Then the other thing we wanted to comment about is the issue of the extraordinary and the investment income. We believe that investment income is quite critical when you're doing a TP analysis, and that information should be included in the report. However, for the extraordinary income, since it's a one-off event, then for the MNEs that are within the threshold who are supposed to do the report, then they will give a disclosure on the same. However, it should not then push the MNE into the reporting bracket. Thank you.
Thank you very much, Mr. Kimani. Are there any other interventions? If that is the case, I would like to conclude this item. Okay, so I don't see any flags, so any more flags, so I would like to conclude this item. I would like to thank again to the speakers. They are very clear, and we could have very interesting discussion during this item. Now I would like to propose to have a break until 3:30 at Paris time. So almost 25 minutes from now. Thank you.
Greetings to everyone. Good morning, good afternoon, good evening, depending upon the time zone in which the participants and delegates are. And now we are going to have the last session of the 2 days public consultation meeting, which is being held virtually. And now we will be taking up the issues relating to the content of CBCR. Yesterday also in the second session, we had dealt with certain issues relating to Table 1, such as whether the information therein should be by entity or by jurisdiction, whether consolidated data should be there or it should be aggregated data, or about certain additional information that should be forming part of the Table 1. We had discussion on that. And now for today, we have again certain issues relating to the content of the CBCR, and the agenda item 7A to D corresponds to items 15, 16, 17 and 18 of the public consultation document. The 4 questions which are there, the issues rather, they are that should changes be made to how constituent entities that are not resident in any tax jurisdiction for tax purposes are categorized for CBC reporting purposes, and how information on these entities is reported in Table 1. The next issue is, should fields required in the XML schema, that is tax identification number, that are not in CBCR template in the BEPS Action 13 report be incorporated into the template? The third item is, should standardized industry codes be included in Table 2, and should predetermined fields be added to Table 3 in addition to free text? With regard to all the four issues, the 2 questions were common. That is, are there any benefits on adopting any of the changes discussed in these 4 items? And are there any practical challenges or concerns to the MNEs if any of these changes, in addition to those in the document which are there, are adopted? And besides that, one more question was put for views, that was from the perspective of MNE groups, which of the existing industry code standards is most likely to be the least burdensome and most useful in providing information on the activities of constituent entities? I would like to invite our panelists first to give their views on all these issues, all the 4 issues covering the 3 questions. And after that, we will seek the opinion and views and observations of the participants and the delegates. So now, first of all, I will invite Virosio Barmitis, Transfer Pricing and Tax Global Practices Senior Manager at Respol. Welcome to you, and please come forward for your presentation.
Thank you very much, Madam Chair. Good morning, good afternoon, good evening, everyone. I'm Rocío Bermúdez, representing Repsol, a Spanish-based multinational operating in the oil and gas and energy sectors. Firstly, I would like to thank you, the OECD, for the invitation to participate in this panel discussion, as well as congratulating the Secretariat for this interesting discussion, which is taking place these 2 days. We have the outcome of this meeting has been really fruitful and necessary, because we really need to discuss around the CBCR, which has kept many companies busy in the last years. However, even though 2015 may sound remote today, reality is that since then, only 3 CBC reports have been filed by each MNE for fiscal year 16, 17, and 18. That means that CBCR is still quite a new and recent obligation for which many MNEs have not even received any feedback from tax authorities so far, which should lead us to take things calmly and do not rush in modifying something whose functionality has not been properly tested yet, meaning that we should allow the CBCR tool as it is to success before trying to modify that. However, and having said that, we do not oppose at all to any fine-tunings or clarification to the CBCR as long as they are aimed at making it more useful and always aiming at meeting the goal of being used as a high-level risk assessment tool. However, it's important to consider that any change in the format or information that is included in the CBCR will always mean additional cost and thus would need to be properly balanced against potential benefits. However, I want to make clear that from Repsol perspective, our commitment with a useful and available CBCR for stakeholders is very clear. Actually, a few months ago, we have been the first Spanish MNE which has made public on our website our CBCR voluntarily, so that all our stakeholders can go through it, consult it, and have it available, including not only the financial and fiscal information of Action 13, but also a qualitative self-risk assessment analysis in order to clarify the content of the CBCR. Moving now forward to the particular questions of the panel, as whether any change should be made on how constituent entities that are not resident in any tax jurisdiction for tax purposes categorized for CBCR reporting purposes, and how the information of these entities is reported in Table 1. It is our perspective that no modifications are necessary. In our experience, it is not a common case. It might be maybe for some of the multinationals, but in our experience, it is not. As whether the fields required in the XML schema, such as the tax identification number, that are not included in the CBCR template, could be incorporated into that template. We do not oppose to that modification. Actually, many tax authorities of many countries already request the inclusion of a tax identification number for each constituent entity. So it's a kind of information that we are already filing and including when we submit our CBCR. So we think that modification would be acceptable and feasible. In addition to that, as regards to the standardized industry codes to be included in Table 2, I would say, as I mentioned at the beginning of my presentation, that the MNEs have already prepared our systems to report the information as it is currently required by the Action 13. And as you know, and many companies have mentioned that along these 2 days of discussions, this has cost many time, resources, and people working. In our experience, the existing categories in Table 2 already provide a reasonable and broad enough range of activities under which the business or the activities of each constituent entity can be classified. And also the others category, for which additional information can be provided on the particular activity of the company's group under it, provides the necessary flexibility. So in our perspective, it seems unpractical and impossible to align on utilizing just one set of industry code standards, because reality is broader and this may lead to more confusion than clarification, in addition to the mentioned additional costs of implementation. Finally, as regards to the content of Table 3, and whether predetermined fields should be added. Again, this would mean that additional burden is put on the taxpayer side. And again, my answer would be the same. We do not oppose to that as long as it is properly justified and balance the cost-benefit analysis, meaning that we can include more information, but it has to be only aiming at improving the quality of the CBCR tool as a high-level risk assessment. In our experience, this kind of predetermined fields would not solve the existing problems because there is no one-fits-all size solution, as the necessary information that we are included in Table 3 aims at clarifying the content of the information that we are including in the CBCR, which is something that may vary depending on the industry, the business model, and many other factors. So as far as we see it now, it would be very difficult to substitute the existing Table 3 as it is with predetermined fields. However, we would not oppose to that as long as the free text field would be kept. Thank you very much.
Thank you, Ms. Rocio. Thank you for giving your views very clearly on all the 4 issues. And now I would like to invite Mr. Didier Jacobs, who's Senior Economist at Oxfam, whose interventions we have heard earlier also. So over to you, Mr. Jacobs.
Thank you very much, Chair. Oxfam is a global campaigning organization dedicated to ending poverty and social injustice. We advocate for tax justice in over 20 countries. Before I start, I would like to thank Repsol for publishing their CBC report. That's really true leadership, so thank you very much, Repsol. So as to the first question about entities that are not tax resident anywhere, the consultation document does a good job at laying out the problems, some options, and the pros and cons of each option. The problem is clear. Entities that are not tax resident anywhere pose a big BEPS risk. But some of them are benign, and the current template does not allow identifying which ones. In our view, the best solution is the approach 3 described in the document. The approach 1 and 2 fail to isolate the subsidiaries that pose big BEPS risk. Because, as argued in the paper, the subsidiaries of which the profits are not taxed anywhere are still mixed with subsidiaries of which the profits are taxed at the level of the equity holder or through controlled foreign corporations rules. The approach 4, which is entity level reporting, also fails to isolate those subsidiaries that pose the BEPS risks for the same reason. It would allow identify exactly which subsidiaries don't pay tax themselves, but the profits of some of them might still be taxed at the partner level or through CFC rules. By contrast, the approach 3 really isolates the entities of which the profits are not taxed anywhere. And that's what we want to zero in on. As the consultation document says, approach 3 creates little reporting burden. There is no extra column to be created in table 1 and just 3 additional rows, and it should not be very difficult to categorize tax entities that are not tax resident anywhere among the 3 rows. And the prize is well worth the effort, since the subsidiaries that do not pay tax anywhere are really those that pose the highest BEPS risk. We recommend 2 amendments to approach 3. First, for those entities of which the profit is not taxed anywhere, so those in category G of the consultation document, we recommend that they be listed separately along approach 4. So we want to apply approach 4 entity level reporting to category G entities only. And that would shed maximum light on the entities that pose the most BEPS risk. A second amendment we propose is to add an additional category, and that's tax transparent entities that are registered in a given country and of which the entire profit is taxed at the level of the equity holder in that same country, should be included in the line of that country, not in a separate line for stateless entities. I think that's just a matter of course. So to close my remarks on this first item, 7A, it is important to recall that the issue of residence is central to international tax. Decisions such as the selection of country of incorporation or the selection of country of management and control are important part of the BEPS toolkit. And these decisions can be made independently of where physical operations are located. So we've heard a lot about reporting burden in the past couple of days, but I'd like to stress that the reporting burden is directly proportional to the complexity of corporate structures, and the complexity of corporate structures is largely driven by tax planning. So the whole purpose of BEPS of the BEPS exercise is to reduce aggressive tax planning. I mean, the whole purpose of the OECD BEPS process is to reduce aggressive tax planning. So while reporting burden is generally a bad thing, in this case, it actually serves the purpose. It discourages complex structures and thereby discourages aggressive tax planning. I'd like to now move to the second question on which I actually don't have any comments. It seems to me a matter of course that the CBC report template should require addresses and tax identification numbers for the reasons provided in the document. On the third question about industry codes, we support the inclusion of industry codes in Table 2. That is useful for statistical analysis. We definitely want the aggregate data that will be published to be broken down by industry, but entity level industry codes would also be useful for tax administration. And when CBC reports will eventually be published, which we very much want and we believe they will, it would be invaluable for academics and other stakeholders to have the industry codes, and that would really allow research to advance knowledge in multiple fields. So we realize that coding entities involve some extra work, and there is some complexity in it, for instance, for entities that are engaged in multiple industries, but coding standards do provide instructions addressing these difficulties. And so we believe that identifying a company's industry should be a basic part of the basic cost of setting up and running a company. And we recommend using ISIC code, which is a standard of the United Nations, and so it's used by all countries, even though some countries have other default standards, the main coding standards. Eventually, all countries report to the United Nations. Finally, on the last questions about the Table 3, I don't have any specific comments on Table 3. I would just note that as a civil society organization, we do not have access to Table 3. The aggregate data, which we hope to see very soon, will not include any data from Table 3. And even though we very much want the CBC reports to be published, we only expect Tables 1 and 2 to be published. Table 3 may include references to other parts of tax returns and to other confidential information. So we don't expect to see Table 3. We expect companies to publish Tables 1 and 2 of the CBC reports, and we believe that the companies will themselves want to add some narratives to these tables to help the public understand them. But those narratives are likely to be different and less detailed than what the companies write for tax administration. So that is what Repsol has done, for instance, and that is fine. So to close, I'd like to thank Repsol again for the leadership. Thank you very much.
Thank you, Mr. Jacobs, for your clear views on all covered.
Excuse me, Madam Chair, I think you've muted yourself.
Thank you, Mr. Jacobs, for your clear views on covering all the 4 issues. And now I would invite Mr. Ulrich Sauter, Global Head of Transfer Pricing at Novartis.
Thank you, Madam Chair, for providing me the opportunity to express my thoughts to you on this panel today. I hope you can hear me, and a quick confirmation would be appreciated.
Yes, yes, we can hear you.
Okay, great. Yes, Novartis is one of the world leading pharmaceutical groups. Our purpose is to reimagine medicines to improve and extend people's lives. Let me also start with some general remarks in the beginning. I believe the country-by-country report is a useful tool to tax authorities in their risk analysis of multinational enterprises. Any change requires MNEs to adjust their ways of working, processes, and systems. Such changes ask for financial and people investment. Therefore, any change should only be agreed on if it reveals new and critical additional information. The goal of this country-by-country report is to provide sufficient information to make a high-level risk review of an enemy. I personally believe that the current data set already provides the information required to fulfill the goals of CBCR. I doubt that in general changes other than additional clarifications are required. Now in more detail, I want to address the 4 questions which you lined out in the beginning. On the stateless entities, currently the guidance feels unclear and leaves room for interpretation. Now, from my point of view, a double counting of such stateless entities seems to be possible. A clarification is therefore welcomed. From my point of view, the aim of this clarification should be to clearly identify income that is not taxed in any jurisdiction. I doubt that the current proposals will bring the clarity and fear they might even increase the uncertainty and confusion. I believe entities which are taxed in certain jurisdictions should be reported in these jurisdictions and not reported as stateless. Only entities and their financial results which are not taxed in any jurisdiction should be reported as stateless entities. Such a reporting change would then clearly highlight potential issues on which reviewing authorities can follow up on. On the alignment of the CBCR template, as the speakers before already said, and as it is indicated, we are aligned that tax authorities already asked for the tax identification number to be reported. So this proposed change is more a correction in the general guidance to align to the existing requirement. This change is therefore very welcomed as it officializes an existing reporting requirement. On the inclusion of industry codes, Table 3 already includes the major functions of each legal entity, and in the master file and in the local file, an NME describes itself as a group and the industry sector it operates in. Already now, any entity which is not linked to the core business also ought to be highlighted in the comment field in Table 2. Furthermore, there is not one globally aligned industry code standard. A common standard would first need to be defined. Also, entities might then fall under different industry codes. So in summary, from my point of view, the inclusion of standardized industry codes does not bring any additional information gain to the analysis of the CBC report, while it adds new additional complexities. Regarding the predefined fields in Table 3, in my view, Table 3 is a very flexible tool. Any information can be included in the existing free fields. To change Table 3 by introducing predetermined fields might only bring additional complications, while the required information can already now be included in the free fields. A clear definition and sequence of information to be reported in the free text fields seems to me the easiest way if a standardization of the information to be provided in Table 3 is really envisaged. Thank you again for providing me the opportunity to share my thoughts.
Thank you, Mr. Sauter. Thank you for sharing your views with us. And now I will invite our last speaker, Mr. Graham Wood, who is Director of Global Taxes at Procter & Gamble.
Madam Chair, thank you very much. First of all, I'd just like to thank the Secretariat for how smoothly this virtual session seems to have gone. Hopefully that's going to continue while I make my remarks and we don't have any internet interruptions. I'd also, I think as the head of transfer pricing at P&G, which is I think as you probably know, it's a US multinational, $70 billion of sales. We have presence in over 70 countries. Obviously, we don't have any threshold questions like the prior panel. But I'd like to thank the Secretariat for the opportunity to comment on the various specific content questions. I'll try not to repeat the remarks from Repsol and Novartis, but I would like to say that in general, I think I agree with most of what they said. Perhaps just to re-emphasize a couple of points, the preparation and the provision of CBCR and all the associated processes, such as notification, which I think was mentioned in one of the earlier comments yesterday, has certainly involved a substantial investment from our perspective, both in terms of systems and people, even though I would say we have a pretty standard system. So you would think it should be relatively easy to put together. I would just like to say it's not as easy as people think it is. And I think in that vein, therefore, as a company, we would say that if there are to be any changes, there needs to be really careful consideration, both with regard to the nature of those changes, the benefit of those changes for a high-level risk assessment, and also the timing, because I think, as we all know, there is other projects going on at the same time which may have impact on this. Assembling all of the relevant data, even where, as I've said, we've got pretty standard systems, doesn't just happen with the push of a button. There's a lot of work goes behind it. I think Richard Murphy said yesterday that perfection is impossible. I think it is. But I would certainly say that we've sought to do as good a job as we possibly can in terms of putting together our C/C for the provision either through the relevant exchange mechanism or in a number of cases where we have made direct submission where C/C provisions are relevant in those countries. I think we're pretty happy with what we've put together. We think standardization is incredibly important here, and I think it would be very helpful given that there are sort of multiple avenues of submission and some differences in the versions of C/C between markets, that we can try to standardize things. And I think my comments are going to be made in that vein. So first of all, if I turn to question one with regard to stateless entities. Frankly, I don't think I've got very much to add to the comments that were made by Novartis. I would say, as a company, we would believe that we shouldn't have anything included in stateless. However, we do. And frankly, that I think seems to be misleading. I mean, I'm just going to give you a couple of examples of situations that we have, just to sort of build on the comments that are in the public consultation. And you may ask a question: why do we have these situations? Generally, there's some historical reason which is out there. But what I can certainly assure everybody is that this income that's included in stateless is being taxed where the business operations are taking place. So we have situations where we have a distribution entity which has been reported both in stateless and in the market where the partners of that distribution entity are located. So the entity, the partnership, is in the country. It has two partners in the same country. We show revenue and profits, if you like, in both cases. The employees are stateless, which seems to be a little unusual to have some stateless employees. That's how we've been reporting them. Tax has been paid in the country. And it doesn't clearly show, though, by showing that the revenue and profits in stateless, it wouldn't really be clear where that tax has been paid or who's paid that tax. A second situation is where we've got a plant which is in one country, which is a partnership, has two partners in another country. Again, you have duplication. You have tax being paid in the country where the plant is, but you have the nothing effectively showing up in the C/C report with regard to that country. So the tax is showing up in the country of where the partners are. Employees are showing up in stateless. So I think if we come back, I think it's very much in line with what Novartis said. What should be included in stateless essentially is to include situations where there is income which is not being taxed anyway. Now, where that falls in any of the definitions of 1 to 4, I'll leave others to decide, but I think we just need to think what needs to be there to give an appropriate presentation and an appropriate ability for high-level risk assessment by the various tax authority recipients. The other questions, I think, are all around standardization. I think the first one with regard to the differences between XML schema and the template, what I would say there is that we file our C/C in the US, XML schema, and our filing in the US would include the tax identification number. So we already do that. I don't really have any questions as to why that should be included in the C/C model template. I appreciate there might be some instances where it perhaps is difficult for some companies to get at that data, but at least from our perspective, we would be fine with that being included. I think at least it also allows some clarity of identification of the entity from year to year. With regard to address, I'm not sure how that really is of any great benefit to a high-level risk assessment. I mean, addresses can change. What does does that actually tell you anything? And I think that also requires a lot more work on the part of the multinational to each year go and get what might be a relevant address. So I'm not sure that really helps, and I think that needs to be looked at in the context of the sort of cost benefit question. With regard to SIC codes, again, I think the comments that Novartis made were very pertinent. I think in many cases, companies would have multiple SIC codes. There would be lots of decision-making required to be made, which, how granular would that be? What benefit would there be from that, particularly when all of the information with regard to a company is contained in the rest of its transfer pricing documentation, so in the master file and the local file. I mean, one option might be something very simple on table 3, some sort of drop-down menu. But what would that say? If I looked at our company, it would probably say we were consumer products non-durable, something along those lines. But that would be much simpler than using any of the SIC or NACE or the international SIC coding system which I think would involve a lot of work for companies. And I'm not sure how much benefit it would really give over and above what's currently being provided in Table 2. With regard to Table 3, I think it's important to maintain the free-form approach. Maybe there's one or two things that could be included. Perhaps the comment I've just made around some sort of drop-down menu. But beyond that, you may talk about gap, about which gap has been used. But again, I appreciate that some countries are looking at using local, some companies rather are looking at using local gap in different places. We aren't, we'd be using US gap for our reporting. I just wonder how much help it would actually be to have such a preformed set of criteria. I think the important thing is what's included in the freeform information. So again, I'd like to thank the Secretariat for the opportunity to provide our thoughts, and so we look forward to engaging in any ongoing dialogue as this moves forward. So thank you very much.
Thank you, Mr. Wood, for your detailed and very comprehensive views. And with that, we come to the end of the views of speakers. And I thank all of you very much for very clearly bringing out your views on all the 4 issues which we had for the agenda for today. And now I open the floor for comments by the participants, and I request that please share your views, please make your observations, and if you have any questions with the speakers who have just now expressed their views, you may raise them also. I see three participants who are seeking intervention. First of all, I would invite Mr. David Murray from Anglo-American.
Thank you very much, and thank you to all the other speakers. I think there's much to agree on there actually between everybody. I mean, I'll raise a few comments in relation to all the questions and how they impact our business and how we deal with them. I can't comment on the stateless entities question because that's not something we deal with, so I don't think that would be appropriate. In terms of the additional information like tax identification number and address, that is information that we already have and already report, so I don't think that would cause us any additional burden to include that in our case. And it's the same with standardized industry codes. I think for us and for many MNEs, they already have standard industry codes recorded on an entity basis. But I do take the point that that's not true for all MNEs, and even where it is true, it will be under different standards. I think what might help us would actually be the option to include in place of business activity, because there's an inherent subjectivity to business activity that we would be able to avoid if we just went down the road of using the SICs that we already do. But I don't think that should be something that's mandated, because, as I say, there are different groups out there that don't collect that data or that use different standards. And I actually thought the consultation document did a pretty good job in this area of highlighting the benefits and the challenges in those areas. On Table 3, I think it was a fairly uniform agreement from everyone. I don't think that having pre-filled or pre-identified forms in Table 3 would add anything. I think that the real value in there is being able to explain the things that tax administrations are going to need to know and going to need to ask about anyway. So I think trying to second guess that would probably just overcomplicate things. So we wouldn't favour that, but that's all I have. Thank you.
Chair, you are muted.
Madam Chair, I think you are muted.
Yeah, now it's okay. Thank you, Mr. Murray, for sharing your thoughts with us. And now I will request Mr. Murphy to share his views with us.
Thank you. I want to come in on only the first part of this because the rest is technical, and to be honest, I'm not really able to provide comment. I don't think I can add value there. But on the question 7A, the whole point of the discussion about stateless entities was to try to avoid transactions, companies, entities falling through the gap of reporting. That's why the question arose. It has been addressed in the GRI standard, and I think I will refer to that again and suggest there is an option to adopt the approach made there. I will declare an interest, of course, I was involved in preparing that. But there is another issue which I think is just as important, because one of the critical points to me is that the data that is in the CBCR reports must also reconcile with the overall reporting of the entity, i.e. the group accounts, or else we can't be sure we have completeness. And controls in total are fundamental to accounting, as many here will know. But the reality is that if we look at the group accounts and we look at the reports that will be presented for the purposes of CBCR, the big reconciling item will be the group consolidation journals. And the reality is that group consolidation journals do have taxation consequences. At least they don't at the entity level, of course, but they do with regard to the overall level of profitability reported. And so there is a question as to whether, in fact, those journals do in themselves have a taxation consequence in that they hide or disclose issues that might be of relevance to the understanding of the group's affairs, particularly how intergroup profits have been recognized or not, and how they have been eliminated or not from disclosure for these purposes. And because we are precisely looking at the issue of intergroup transactions with regard to CBCR, that was its original intention and purpose, then these journals still remain highly relevant. There isn't clear guidance on how to deal with this inside the standard, in my opinion. I have raised the issue before. I'm putting it on the table now because in comparison to the issue of stateless entities, the issue of stateless consolidation journals, which nonetheless require explanation to be able to understand the tax affairs of the group as a whole, is really significant. And what I would like there to be consideration of when we do actually have revision to this standard, and I'm sure we will have revision to this standard because the case for reform has been made, in my opinion, then we do need to address this issue as well. Guidance at the very least has to be provided as to how those consequences and that reconciliation of those consequences can be presented so that tax authorities and others can understand them to make sure that for the sake of the entity itself, there is no misunderstanding and false accusation of profit shifting when there may or not be any at all. And I think this point is vital. It's often assumed that CBCR, well, I sense there's a feeling that CBCR is there to catch people out. No, it isn't. Like all accounting, it's there to present a true and fair view. And if these explanations are included, then the chance of people suffering a misunderstanding is much reduced. So this does need to be on the table and addressed, I think. Thank you.
Thank you, Mr. Murphy, for sharing your thoughts with us. Now I invite Tanya to share her views.
Thank you, Madam Chair. I would like to simply echo a lot of what has been said. Very good points notably made by Rocio. I will just add a few comments. First of all, on the additional fields in the report, TINs, addresses, I would just like to emphasize the fact that it's not always an easy job to get these information. So I would really caution against expanding any mandatory event. Another aspect of this is that even if the information is made mandatory, maybe countries should be very careful that the XML reporting sheet does not put these information as validation, meaning it would be these information are for some reason absent. So that's a first point. It's a bit technical, but it's also important. On standardized codes, I think I would like to emphasize what Rocio said earlier, that the categories that are currently included in the template are sufficient in our view. And I mean, the consultation document very clearly explains that there is a variety of industry codes, and we really question why one should be favored over another. There's a level playing field issue there, I think. A last comment maybe on table 3. I would like to emphasize that we really need to keep the free text zone maintained. That's really important. Maybe there can be improvements made, but that should be really balanced against the expected benefits. And for example, I would like to point out that we believe that category 3, which I know these are examples, but category 3, which pertain to acquisitions, disposals, that in our view goes really too far, because this is the kind of information that is already in the master file and local file. So we would not favor entering into this kind of detail. And it also raises the question of materiality, that category 3. So category 3 is an example of what we would not like to have. Then I would just end with a final observation, which is more generally to say that there may be a general perception that the changes sometimes may seem reasonable, do not seem to be very burdensome. That is when you look at them in isolation. When you start accumulating all the changes that we are discussing, then that is really burdensome, and you enter into a world of complexity. So this is more of a call for IF members when considering changes, when discussing changes, to make sure you look at the big picture and take into account all the changes that are being asked to business. And this will be really important during this review process. And last remark, I've made this point yesterday, but I would really like to emphasize this. If changes are made to the standard, especially if major changes are made to the standard, it's really important that we have sufficient lead time, that changes do not be implemented, for instance, before 2025, especially in the context of the current economic crisis. This is really an important point. Thank you very much.
Thank you, Tanya. Thank you for your comments. Now I invite Mr. Olivier Herman from TEI.
Thank you, Mrs. Chairman. Thank you, Mrs. Chairman. Two points. First, I'd like to respond to Mr. Jacobs, in particular his statement that the complexity is driven by tax planning. The reality is often more nuanced. The complexity that companies have may be driven by the business reasons, in particular regulatory requirements. In regulated business, very often companies are required to have separate legal entities. And another reason is that M&A groups very often make acquisitions, and they don't acquire. Sometimes they acquire one single entity, but very often they acquire an entity that have multiple subsidiaries. So it adds a lot of complexity to the structure because it's not aligned with the structure of the acquiring group. The acquired group is often on different systems, and it takes a lot of time and efforts to simplify the structure. The second point is that I just want to concur with the comments made by Repsol, Novartis, and Procter & Gamble with respect to the various questions and items that they covered. I mean, TI is in agreement with that. Thank you.
Thank you, Mr. Herman. Thank you for your comments. Now I don't see any more flags. Mr. Jacobs, would you like do you have any comments to make on the remark just made by the previous speaker?
Not really. I mean, it's true that the complexity is not solely due to tax planning. I didn't mean to say that. The reasons Mr. Herman provided are indeed very relevant. But still, for instance, the existence of stateless entities not paying taxes anywhere, that's definitely something driven by, I mean, the whole purpose of it is tax planning, and that is what this exercise is trying to get at. And in fact, I've heard there is a consensus on that point, that whatever the final outcome of this review is, we do want to have a clear system that identifies or that separates the entities that, not just the entities that are stateless as defined now, but the entities that of which the profits are not taxed anywhere, even at the level of other entities. So I think my general point remains true, that the most aggressive tax planning involves more complex reporting and reporting burden. But the reporting burden is not solely a function of tax planning.
Thank you, Mr. Jacobs, for that clarification. I don't see any more flags. I will once again make a request to the participants and also the delegates to make their observations, comments, if any, and especially the delegates, if they have any question with the participants and they want to have their views on any of the issues which have been discussed from the public consultation document, they all are available with you, and this is a very it's an opportunity given to you to get their views. So if you have any questions, please raise your hand. I think till the time the delegates or participants decide whether they have any views to express or not, we will have a look at the chat. We see there are a number of messages over here. I would request the delegates or the speaker or the participants, if they could express their views, what they've written in the chat, that will be really nice if you can. Yeah, I see a flag from Mr. Tomohiko Kamiya. Please go ahead.
Yes, thank you. I want to raise some another issue. I want to point out that notification rule, notification of CBCR to tax administration, which Mr. David R. Nick of PwC mentioned on day one. Especially, I would like to comment on the timing issue of notification. The BEPS Action 3 report shows a model legislation. In model legislation, Article 3 sets the end of reporting year as the notification deadline. Nevertheless, many jurisdictions defer the deadline. In fact, constituent entities for CBCR reporting are often determined after the process of preparing accounting statements. Consequently, it is very difficult to determine the constituent entities based on the information available at the end of the reporting year. So we think the model legislation should be revised, stating that notification should be set at least several months after the end of the fiscal year. Thank you very much.
Thank you, Kamiya-san, for your intervention. And now we don't see any other flags. So in the meantime, we will try to read out the chat messages. There is a message from Peru, Larissa Coelho. Isn't most of the information contained in CBCR already published or made public by the MNE group in the country where it is resident? If so, what issue could you possibly have the same is made available to other countries where they have operations? And there is no. This is from Nigeria, sorry. Then from Peru, the message is nowadays many jurisdictions know what kind of information are registered in Table 3. So analyzing them, the schema should include some default codes and also general information. I will request Nigeria and Peru, if they could speak out their thoughts and they share their thoughts with us. It would be good for us.
Good morning, good evening, good afternoon, everyone. Thank you, Chair. I was trying to answer the question of Nigeria, Emmanuel, because he said that the information of the CBC report nowadays is published by many MNE groups. And so in my country, this is not the same case. So I said that is also the situation is not the same in all countries, so it should be considered in that way.
Thank you. Now going back to the issue of notification raised by Kajaran, is there anyone else who has the same views or similar views or would like to expand on that issue of notification?
Just to speak forward from the Secretariat on this issue, Madam Chair. Sorry, unfortunately, I raised my hand.
Sure.
The Secretariat is very much aware of the concerns that businesses raised around notifications, and I think in particular around the fact that when BEPS Sanction 13 was implemented, there was no standardized format for notifications, and so countries have adapted approaches which suit their particular needs, and even where those needs are aligned, they've just taken different approaches in terms of deadline, format, and so on and so forth. And we are aware that business find that a particular challenge. One thing which business at OECD asked us to undertake last year, and we have now done on the OECD website, is to, while countries are not currently aligning their notification requirements, at least now on the OECD website, we are including a list of all the Inclusive Framework members with notification requirements and the details of those, so the timing of them, what information needs to be provided, which constituent entities need to provide the information, so on and so forth. And so hopefully, while that doesn't remove the obligation to comply with the requirements, hopefully it's gone some way to help M&E groups in understanding what the requirements are in the different countries where they have operations. I'm not sure if many people are aware that that was on our website, so given the discussion, I just wanted to mention that. Thank you.
Thank you, Mark. Thank you for that clarification. We have one more. Request for intervention. Anna Prezeminska from ABB. Please share your views with us.
Thank you, Madam Chair. I only wanted to point out that regarding the notification processes, most multinationals have the same ultimate parent filing the country-by-country report year over year. Yet the notification in most countries has to be made every year with the same repetitive information, which is an administration effort for the M&Es, but I would assume this is also an administration effort for the tax authorities to receive and file and process those notifications. So we would consider maybe an option that a notification is valid until it's changed or revoked. I think this is already the case for several other registrations and notification obligations that exist in the countries. And that way, I think the tax authorities could somehow tick which is the right legal entity as the ultimate parent, and until the organization of the group changes and it is required that another legal entity files the country-by-country report, everybody could be confident that this is the right legal entity and there's no more additional administration efforts on both sides actually to reconfirm whatever has been already filed. Thank you a lot.
Thank you, Ms. Anna. Any other intervention?
Na każdej poczcie. I szkołko nie prywatnie się pisze nie I to znać. A to, że ja ci tu składam proste tak to hard.
Somebody's mic is on, or somebody wants to make intervention. There are some more messages in the chat. Would the participant want to speak out? Christian Hader, would you like to speak out? Mr. Hader? I think, yeah, now there's a request from Nigeria. Emmanuel East, please go ahead.
Madam Chair, thank you, Manu. I go back to a little bit to the issue raised before about the usage of CBCR data. Well, I believe that should the Secretariat try to use the opportunity to sample opinions or do a note on the actual usage of the CBCR by the countries who have been assessing it so far. It will serve as a motivation for some other countries who are struggling to get a level where they assess it to push through and then to start trying to assess them. This is important because there have been a lot of reports out there saying the information collected are not used for anything. So such notes will underline whether or not the people who have assessed it so far are using it for the purposes for which it is meant for, or the reform that is being carried on now, we take note as to why that may not be the case. Thank you, Madam Chair.
Thank you, Mr. Emmanuel. Thank you for your intervention. And now I don't see any other flag. Now I would request all the participants, if they have any comments on any other issue, they may share that with us because we have some time left with us. So I invite your comments on any other issue which you would like to give your comments on. Yes, yes. Mr. Emmanuel, you want to intervene again? No. Mr. Oliver Herman, floor is yours.
Yes, thank you, Madam Chairman. Just a general comment. First, I'd like to thank the OECD for organizing this two-day meeting. I think it was very well run, and there were a lot of good comments and exchanges. I'd like to highlight that the sessions focused on specific items, and I think it was the only way to keep the discussion, in an organized manner. But several of these discussion topics are actually interconnected, and with respect to the topic related to the threshold in particular, they are also connected to other projects, in particular, Pillar 1, Pillar 2, the BEPS 2.0 initiative. So I think it's really key to not make decisions with respect to the C/CR in silos, looking at each topic in isolation, but it's important to keep the big picture in mind because of the side effects, the impacts on other aspects, other projects and issues that it could have. Otherwise, thanks again for organizing those 2 days. I think they were really helpful.
Thank you, Mr. Herman. Thank you for your comments. Any other intervention? Yes, Mr. Daniel.
Hi, it's Daniel Gallen from the Association of British Insurers here. Thank you very much for organising a very informative couple of days sessions. It's been really interesting. One of the points I would like to reiterate, it's been mentioned previously, is just the timescales for any changes. As a lot of these changes would require significant system development and require, input from different parts of the business across different territories and across different IT systems and different specialists and functions. Having reasonable advance notice and a reasonable lead-in time will be very important. A lot of system development over the last couple of years will have taken into account the existing requirements for things like, Oracle consolidation systems or SAP or whatever. It will be important to make sure that, that any changes are flagged, in advance in enough time that there's not undue administrative burden onto business. Thank you.
Thank you, Mr. Daniel. Mr. Murphy, please.
As we're now in effectively a closing session, I'd just like to go back to something that both Will Morris and I said when we were invited to speak at the start of the conference. And Will and I did not in any way cooperate with each other before we spoke, although we are personal friends. We both said that the question here is very largely a matter of trust. Will said it before I did, but I'd reiterate it. One of the big issues that is coming out here is the question of whether this information is available to users or not. And the current context is twofold. One, I keep hearing, please delay, we can't afford to do it. And I'd say, please do it, you can't afford not to do it. And what I mean by that is you cannot afford to delay putting this information into the public domain. There is a pattern around the world right now of massive subsidy to corporations from government to ensure that jobs are maintained. And I have absolutely no problem with that, and I'm sure that nobody in civil society here has an issue with that. But the maintenance of confidence in business to ensure that this pattern of support can continue to be supplied, and at the moment of the direction of flow is as much towards business as away from it, is critical. And therefore, accepting that there is an obligation to account on a country-by-country reporting basis to each and every jurisdiction that hosts the activities of a multinational company is vital. Please, please understand, we are not talking just tax data here. Indeed, we aren't even talking tax data at all, because this information is not used for the purpose of tax assessment. It is a tax risk assessment tool, and it's accounting data. And if we don't understand that, if we don't appreciate the importance of that to all the stakeholders of a corporation and not just the tax authority, there will be a loss of confidence. And we cannot afford that loss of confidence in the business community. And therefore, to move forward on that issue is now absolutely vital. I reiterate that appeal. It wasn't just me who made it. Will Morris made it too. Please, can we take that into account? Thank you.
Thank you, Mr. Murphy, for your advice. That's very valuable to us. Now, I do not see any more flags. I think, so with that, we come to the end of our 2 days virtual meeting, and I will sum up the discussions which have taken place. We have discussed a number of issues relating to CBCR. We have discussed the issues relating to its implementation, its operation, and a number of issues relating to scope and content of the country-by-country reporting. And under the scope, we have discussed items 4, 5, 6, 7 to 11, which deal with the issues relating to threshold, the single enterprise having a PE, whether that should be considered as a constituent entity, and we have certain accounting period related issues we have considered. And then under the content of CBCR, we have considered item 12 to 18 of the public consultation document, and that relates to additions to the table 1, changes relating to table 1, insertion of standardized code, industry code in table 2, and inclusion of predetermined field in table 3. And we had the opportunity. Sorry, I think there is a hand raised. Sorry, I will first. Mr. Emmanuel, you wanted to intervene? Please go ahead.
Sorry to interfere, Madam Chair. Just my hand was raised a long time, but I think it didn't say it on time. So there's one extra issue in the design of CBCR which Nigeria have concern over. Under the conditions, there are situations where you are able to give information but not receive. So I see this as an opportunity to flag our concern on this design. If for any reason a country is unable to receive, that same country shouldn't be under any form of obligation to give. So that's just it. I want that point to be taken on board as we consider the design of updating of the CBCR. Thank you.
Thank you, Mr. Emmanuel. I'm sorry that I could see your flag a little later. I'm sorry about that. And with that, we come to an end. And before closing, I would request Mark to give his final comments about it, because it is the Secretariat which has worked very hard. What Mr. Murphy told yesterday, that we should not be complacent because we have to do a lot, and that is literally being followed by the Secretariat. They have worked very hard. This meeting was scheduled for the month of March, but which could not be held because of these unforeseen circumstances. But the Secretariat has made it possible through this this virtual meeting. So before we come to an end, I would invite Mark to give his final comments. Mark, over to you.
Thank you very much, Madam Chair, and thank you everybody for their comments over the last couple of days. I would just reflecting on that last comment, that there has been a huge amount of work in organising this, but it hasn't been work of myself. And I'd certainly like to recognise in particular Wanda, who spoke earlier, and other members of the team, that they have been the ones carrying and making sure that this ran as smoothly as possible. So thank you very much to the rest of the team. I would confess that when I suggested to my head of division that I wanted to undertake this public consultation by Zoom, I was regarded as perhaps having gone mad. But I'm really, really happy that we have. It isn't ideal to do this kind of conversation not in a single room, but I think it was a really important conversation that we had, and I'm glad that we've managed to do this. I would actually almost go as far to say that perhaps some of the people that have been involved and have been contributing wouldn't have been able to participate in a face-to-face meeting in Paris, and perhaps we've even had a richer conversation as a result. And as Secretariat, I'll certainly be taking that on board in future, that perhaps this kind of virtual conversation should be maintained even when we are all able to get together and we do meet face to face, that we continue to make this use of the technology. So over the last 2 days, we've been taking frantic notes of everybody's comments and thinking about what they mean. We've received really useful input on all of the issues within the public consultation document, some things where you support changes or greater consistency. Clear message where there are some issues where those are not supported by non-government stakeholders, and we will now be going to take that into account in our future deliberations. We've also received really, really useful comments on things that weren't in the public consultation document, and I think those are also things which we will need to reflect on and inform conversations that I'll be coordinating with our delegates over the coming weeks and coming months. I've been listening very closely over the last 2 days. I've been taking everything well. I'm sure that the 100 and some government officials that have also been online have been listening, and we will be virtually meeting shortly to discuss how to take these into account going forward. A couple of comments, perhaps not just reflecting on what's been said, but I am kind of within the Secretariat, have general responsibility for CBC reporting. You now know my name, you've seen my face, and I would be very happy for people to continue to reach out to me directly, be it through the OECD website. If you have any areas where you feel that greater clarity is needed or where guidance would be beneficial, I'm always interested to hear from business, from NGOs or from governments about where we can provide greater clarity and greater consistency. And reflecting on one of the comments earlier from Nigeria, any tax administration officials that are not one of my usual delegates that I don't perhaps know personally, if you want to reach out to me to have any of these questions about how useful CBC reports might be, how they're being used, as I say, I'm not actually involved in using them, but I can do what I can to either help directly or to put you in touch with people that can provide greater clarity. Responding to a couple of the final comments that were made, one comment from the Association of British Insurers about timing. Whatever happens coming out of today and about revisions to the standard, I will do what I can. I can give you comfort now that there will be time before any change is made. In the conversations that we normally have within the working parties, there is generally not a will from countries to make changes to their law quickly. We will be reflecting on these and making sure that everything is done in a timely manner and people are given time to adapt to that. also just reflecting very briefly on the comment that was made a moment ago on interactions with digital. I think this public consultation has deliberately focused on issues surrounding CBC reports for the purposes of a high-level transfer pricing and other BEPS-related risk assessment. We are mindful that we need to make sure any changes are aligned with other parts of the OECD's program of work, and that will happen. But I think for the purpose of this discussion, we really wanted to focus on the 2020 review as it was originally designed, i.e. a review of Action 13 for the purposes of risk assessment. But that doesn't mean that we're all kind of working in silos. There are silos at the OECD, but most of the Secretariat are in multiple of them. So there are, the interactions are well known. Other than that, I would just like to repeat my thanks to everybody for your written comments, for your comments during the meeting, and to remind you that in the coming days, perhaps even before we go to bed tonight, the recording of the meeting will be placed on our website on the public consultation page, as will a copy of the PowerPoint presentation that was used over the last 2 days. So certainly I would expect by tomorrow you should be able to access both of those. So again, to repeat my thanks, to say thank you very much to the absolutely excellent chairing over the last 2 days by our co-chairs, Mr. Takehiro Yasui and Madame Taika Saxena. And I look forward to seeing all of you at future consultations, hopefully face to face. Thank you.
Thank you, Mark. Thank you always for all the effort and all the logistics, everything what you all have given. And now with that, we come to the end of our two-day very interesting meeting. Though we were sitting at different parts of the world, but we all felt that we are very well connected to each other. And many of us share the views also in the similar way. Now I would say that now with that we come to the end of this meeting. I thank all the speakers. I'm very grateful to them that they could spare time, they could prepare their slides and give it to the Secretariat so that they can fix it with this virtual meeting, and we can have that. For all the speakers, thank you very much for sharing your views with us on all the issues which were raised, and all the participants, thank you very much for being connected with us, and all the delegates from various countries, thanks a lot to all of you. In these trying times, all of you could spare so much of time and get connected with us and join us for this. And at the end, I would like to thank Mark, Wanda, Sonia, Myra, Taka, Debra, and other supporting team, that is Karja and Articulo. If I have left out somebody's name, I'm sorry. Everyone who has been from the Secretariat, who has been helping in making this meeting very successful, thanks to all of you, and I wish you all a very safe and healthy life and wish very good health to all of you and your family members. With that, we come to an end. Goodbye, and hope to see you all in Paris. I hope things will get better soon. Thanks a lot. Thank you and bye.